Welcome everyone to the Field of Vision video with Jim Dalton. Thank you for being here today, and we have a full day to hear Jim share 40 years of market understanding and market experience and trading experience with us. And we're all very fortunate to be a part of it. Jim's taken a lot of time to lay the slides out and the material out in a way that we can fit as much info as possible with our time here today, and he's also laid it out and put a lot of thought into how to structure it so that it'll flow and you can absorb it and go home and start implementing it in your trading regimen. Obviously that's why we're here, to trade better, and that's how this program was designed for you to go home and trade. Jim, I've been working with Jim about a year, and he has asked me to just talk a little bit about the learning process because he's watched me struggle, and at the same time he's watched me come to a new level of trading. And I do believe that this is an edge we develop within ourselves. It's not an edge from an indicator or a strategy or a methodology. This is something that we are developing internally. Intuitively, we are developing what we see. No one can take it from us once we have it. And to me, that's very exciting, because when I am trading well, it's like hitting a golf ball really well. You change your grip, it is nothing but hook and slice and pain, and then one time you hit it and it just feels perfect. And when I'm trading like that with Jim, that's the feeling, and it makes it all worth it. So I just want to throw that out there because it isn't easy and it won't come overnight, but stick with it, because I do believe that we really have a true edge here, and to utilize 40 years, we don't have to make a new path and reinvent the wheel. We can learn from someone who didn't have a mentor, who is now here because he wants to offer something that he didn't have and share with us. I do want to say one other thing that I did hear when I was signing up for this and investing the money. I was hesitant, and a gentleman said to me when I asked him, should I try it? Should I invest this money? And he said, absolutely. And he had no vested interest in Jim Dalton. He said, you will never look at the markets the same way again. And I can genuinely say that from a year ago when I started, I will never look at the markets the same way again. And there's much more depth, and there's much more interrelationships I consider. And the longer I go through it, the more it becomes more intuitive and natural to me. And I'm very grateful to be a part of it. So with that, if you will help me welcome Mr. Jim Dalton.
Julia, thank you very much. I've watched Julia go through this process, and we were doing an intensive out in Napa. It was the last day of the intensive. We had about an hour to go. And I looked out, and she was kind of leaning over the desk. Her eyes were about this big, and I knew at that point in time that the information that we have talked about had absolutely overwhelmed her. And it was really at that point that she really made the turning point. I talked to her the following week, and that turning point came, and you could see the growth take place. One of the best compliments I think we've ever received. Rick in the middle was telling me yesterday about one of the blogs that he was reading. And one of the blogs, somebody asked about the program that we offer. And they said, no, It was too complex and too complicated. It wasn't for them. That is probably the finest compliment we've ever received, because that is 100% true. If it was, Julia said it, if it was easy, there would be no edge. If it was easy, it would be replicated almost overnight. It is not easy. It is a process that you will go through. But understand that the rewards are huge if you make it. Not many people are going to make the entire process. But we're trying to give you a foundation. Once you have that foundation, then you start to build on the foundation. Let's start off and let's just begin to review some of the basics that are involved. The tool that we use is called market profile. However, market profile is simply a tool. What we are talking about is about trading in all of the intricacies and the interrelationships that occur when you're trading. So many people want to know only where do I get in and where do I get out. It is clearly not that simple. It is far more complex than that. What we talk about is trading. We use the market profile. We call it the market profile graphic. And you'll see as we develop it is when you look at a graphic is something that brings together many complex points at one time. The most famous graphic in the world is the graphic of Napoleon's army going into Russia. From just one simple graphic, you see the size of the army as Napoleon started. You see how the army shrinks. You see the temperature change. You see the distribution of food. From one simple graphic, the most famous graphic in the world, you can understand an awful lot of very complex information in a way that our minds are very welcoming. We welcome looking at graphical type of information. And so this is what, when we get to the market profile graphic, you will see that it is in fact very similar to this famous graphic. Okay, let's take a look and start off. This is just to get you started. This gives you some idea of where we're going to be when we're all done. This is not basic right here. This is kind of how we look at days. For example, up at the top, you'll see something labeled afternoon pullback low. If you have a trend day being a day where the market has moved rapidly, say to the upside, very often late in the afternoon, you will get a pullback or you'll get a little inventory correction. Most people have no idea the significance of that very minor point where the market pulled back. That reference point, late in the afternoon, until it's taken out, nothing's really changed in the marketplace. So we're going to talk about that. We're going to talk about the significance of how do you identify when change takes place. We look around here and we look at significant highs and lows. Triple references. We look at what you're going to be introduced to is called the point of control. Point of control, or the fairest price at which business is being conducted. It's very important. If the fairest price at which business is being conducted throughout the day doesn't change, then you don't have a lot of change in the market. Sometimes you'll see that start to migrate. So all this is just some idea of where you're going to be when we're done with this. That is a point of control right there. You'll understand the significance of that, or the fairest price to do business, as we complete this. You'll understand the importance of the references. Anyhow, this just gives you some feel of what it's going to look like and what you're going to start to understand as we get to the last portion of this presentation. Okay, let's take a look. Structure, another comment in here that you're going to understand. If you think back and visualize a bar chart, most people that have ever traded look at a bar chart. A bar chart is a straight line. On that bar chart, you have an open, high, low, and close. Okay, you have basically 4 data points. You have no dimension to that bar chart. When you look at a profile, and we haven't explained to you yet how you build a profile, but you can look and see that it is not a straight line. When we add another dimension, we get into what we call market structure. We will be talking about what is strong structure, what is weak structure. Just a few days ago, the market had a historic break. The Dow was down over 1,000 points late in the afternoon on a huge drop, and then the market rebounded over 700 points before you knew what time it was. If the underlying structure of that market had been strong, I suspect we would not have had that kind of break. Those that have been looking at the material that we've done for some period of time know that I've been writing about the risk inherent in weak market structure. But you'll start to learn about structure, you'll learn what it means. You'll also learn, just as you would if you had a house with shingles on it and you had a leak, you'll start to learn how do you repair that house? How do you repair, or what happens to repair poor structure in the marketplace? I don't expect you to understand any of this right now. All I want to give you is a flavor of the depth of which we're going to get to before we complete this process. Okay, at its foundation, the market is simply a two-way auction process. The motives and incentives of the buyers and sellers are infinite. But let's talk a little bit about an auction process so you get a feel for it. Most people have been to some kind of an auction. Generally, the auctions you've been to are maybe an art auction, or at one time, years ago, I had a client that owned the Galleria down in Texas. When he used to come in to the programs, he would fly in on his own plane. He would take the whole floor of one of the hotels. And he'd been to 3 or 4 of the programs. And I said, you know, you keep coming back. I said, how is this working for you? He said, well, you know, Mr. Dalton, he said, I'm still not doing a wonderful job of trading the market. But he said, in my life, he said, I buy ponies at the auctions all the time. And he said, they're sure not getting the best of me at the auctions for the ponies anymore. He said, I know what's going on. And he said, I can't tell you what you've done for me, learning to understand how an auction really functions. And he said, I thought I knew. Well, let's walk through an auction process. In a traditional auction process, it goes one way. Let's start with a kind of an expensive art object. If the auctioneer is trying to get the auction started at, say, $100,000, what happens if nobody will lift the bid at $100,000? What does the auctioneer have to do now? He's got to lower the bid, right? So he lowers the bid, and he may have to lower the bid down to $92,000 before the auction can get underway. So all of a sudden, he lowers it to $92,000, and all of a sudden the bidding starts. You got 93, I got 94, I got 95, 97, and sometimes it will tear right back through the original $100,000 level that no one would lift the bid for to begin with. Now, as the auction progresses, you may hear a couple of things. As the auction starts to slow down, the auctioneer has to make it feel exciting and really keep your interest, right? So he starts putting in what is called filler. So let's say the auction slows down at $105,000. Who will give $105,000? And he goes into this elaborate description. And at that point in time, is the auction over? No, the auction's not over. But the auction is slowing down. You need to, if you really become aware of this, you understand what's going on. This same thing takes place in the markets. What happens, what other kind of response might you hear from the auctioneer? Let's say you're up to 105,000 and you've done your homework and you're pretty smug and you think it's certainly not worth 105,000. But at 105,000, all of a sudden you hear the auctioneer say, "New bidder." Well, are higher prices cutting off activity, or are higher prices bringing in more bids and more activity? When you hear the auctioneer say, "New bidder," higher prices are bringing in more activity, not cutting off the activity. Guess what? It doesn't make any difference what you think that value is. That auction's not completed. How many times in a market have you seen price go down, whether it's a stock or whether it's a future? You will see price go down, and all of a sudden, out of nowhere, the price reverses and is going the other way. And you start to see that higher prices, instead of cutting off activity, bring in more and more activity. So one of the things that you really start to need to understand and appreciate is this whole idea of the auction process. This is how markets operate. The first example we talked about was a very simple example. It's a very expensive art auction, one item to be auctioned. Okay? Let's go and talk about where horses are being auctioned. Okay? Horses are being auctioned. It may not be, there may be multiple, horses or livestock available for auction. Now, the same process as the auction gets underway, some people are getting their demand fulfilled, right? So they're dropping by the wayside, and this auction continues, and the auction continues up until what? Till the demand has been filled or everybody has stepped aside. So we go up until the last bidder bid. And that's when the auction is completed. Now, think about this. If the auction was completed successfully, and I now walk out and I say, "Oh, by the way, I have one more of the same thing to auction." If the auction had been successful, and let's say that this item went for, pick a number, $150,000. If the auction was successful, I said, "Oh, by the way, I have one more." Probably shouldn't get any more than 120, 125,000, because the auction ought to go up and it ought to drop away from it very quickly once it's completed. So this is kind of the auction process, extremely important in understanding how markets operate. Now, the difference between the art auction or the auction for livestock or multiple items is that in the stock market, we continually, or futures market, we continually auction from low to high and from high to low. So that ongoing auction process is continuous in there. If you go to the art auction, for example, you have all types of people that are participating, right? And this becomes very important also. You may have a dealer that is at one of the auctions. It could be the art auction, or it can be in the auction for livestock. You may have a dealer that's trying to get inventory for his business, and then he's going to do what? Resell it. So that would be one motivation. You may have a collector, right? You may have a collector, and he wants that for his own personal collection. Maybe it's a legacy thing, or maybe it's an ego type of thing. The motivations go on and on. We talk a lot about, in this time frames, motivation and why, who are the buyers and sellers in these auctions. In the stock and futures market, we auction from low to high and then from high to low in this continual search for information. When the market auctions too high, at that point in time, you start to feel that it was too much. Once it gets too high, then the process starts in the opposite direction, and we start auctioning lower, looking to attract what? If we start auctioning lower, we are searching for what? For buyers, right? As we're auctioning higher, we're looking for sellers. So in this process, this up and down two-way auction process, is generated a tremendous amount of information. And it's that kind of information that we want to capture. Okay, let's take a look at this process. Right here, all this is, and we haven't explained it yet, but this is a market profile. In the one on the left, on this profile, and we've split it out, your first auction is going from high to low, right? So the market started high, it auctioned lower. Down here, it finally got low enough. When you auction lower, you're looking for what? You're looking for buyers. You got low enough to find buyers, and now you start auctioning in the other direction. When you auction in the other direction, you're looking for what? You're looking for sellers. It's that two-way auction process. What you're going to find is we use the market profile in order to record the net effect of that two-way auction process. So this is what it looks like when it's completed. This is what it looks like when it's spread out. And I just put it this way so you can see the auction going lower, looking for buyers, the auction going higher, looking for sellers. And you can see that there is, if you had a bar chart, you'd never see this, right? We talked earlier about a bar chart, one dimension. All we've done is added another dimension. We're going to show you how this is constructed in just a moment. Okay, the following graphic represents a normal distribution curve. Scientists for years have employed a distribution curve in order to organize the data. They employ the curve to organize data, and then so they can study the data. That's the purpose of it. It's a scientific approach to understanding data. All we've done, this is what's called a normal or a bell-shaped curve. Now, I can tell you that it is very rare that you will ever see a normal or bell-shaped curve in the marketplace. But it's the idea of the distribution. What we do, if we start off and we look at a bell-shaped curve, that would be a market that was perfectly balanced. Now what we start to observe is how far out of balance the market is in either direction. When you look at the curve, one standard deviation is going to cover approximately 70, they give you an actual number, 68%, but it's going to cover about 70%. One standard deviation, the fattest part of the curve. Two standard deviations, about 95% of the curve. When you get into three standard deviations, it's going to cover about 99% of the curve. Well, you don't need to worry about those numbers. It is just this idea of how information is distributed. What you're going to find is the market profile graphic really is keyed off of the idea of a normal distribution curve. It is nothing more than a way to organize data. Once the data is organized, now you have a way to start to understand what is going on. And you understand, if you look at a market, and one day you've got maybe 100,000 participants, the next day you've got 150,000 participants, it's all going to vary. If you, let me give you a real life example. Let's say I have a barbecue in my backyard, and I've invited 30 people to that barbecue. And I'm looking out, everybody seems to be having fun, and I look out and I say, Rick, what do you think the average or mean height is of the people at my barbecue? He looks at me, he said, Jim, how would I know? All I do is I go out and I take that same data, I take those 30 people, I organize them under a distribution curve. All of a sudden you start to look at it, he says, oh, well, it looks to me like the average or mean height is maybe it's around 5'7" or 5'8". Now, let's say we take a picture or a snapshot, a satellite flies over, takes a picture of those organized people at my barbecue. Now, some people leave early, right? Some people come in a little bit later. Those that leave early have some height. Those that come in later have a different height. Maybe more left than come back in. So maybe the following morning or late that night, I go out and I reorganize those people again, and I take another satellite photo of the people at my barbecue. All of a sudden, I take one picture, I take the other, and I overlay those two pictures. They're probably not going to be the same, right? So what it's going to allow me to see is some shift that took place in the underlying data. Had I not organized that data, the chances are that I wouldn't have seen or been able to determine subtle shifts that took place in the people attending that barbecue. That's what we're after. We're after the ability to organize data and take that data and start to make some sense out of it. Okay, let's take a look at how we actually form the market profile graphic. In order to form a distribution curve, you need two things. You need a variable and you need a constant. The breakthrough in the ability to organize the data was the discovery by an individual by the name of Pete Stottlemyre. It was majored in statistics at Stanford. The breakthrough was that you can make time the constant. So this time between 11 and 11:30 is the same as the time between 12 and 12:30. One day is as long as the next day, 1 week as long as the next week, etc. So you make time the constant. Time the constant forms your horizontal axis. If you then take price, which is a variable, and plot price the variable against time the constant, you have the makings of formulating a distribution curve in order to organize the data that we're going to be talking about. When Pete came up to talk to me some years back, we had been talking for probably less than 4 minutes when Pete threw out the idea of time as a constant. I knew immediately what he had been discovered. I had been trying to find a way to organize the data. I actually had some things on my desk that looked like distribution curves. At that point in time, I was trying to figure out, how to do certain option strategies. But I knew immediately, I knew my stuff didn't work like it should. I knew that Pete had something when he came in the idea of time as the constant. We talked for another 15 or 20 minutes. Pete walked out to the elevator, walked back in, and he looked at me and said, would you like to sponsor my first book? His name of the first book that introduced this information was called markets and market logic? And I said yes, and on the spot, I wrote him out a check for $10,000. If you ever look at the first book, right across the front, it said sponsored by J.F. Dalton. But I knew the value of the idea of making time the constant. So many great discoveries are far simpler than we would ever imagine. So time the constant versus price the variable allows us to form the distribution curve. If you take, there's a profile, all it is, you start to visualize, it's nothing more than the distribution curve we looked at earlier turned on its side. That's how we organize the data. That's what a market profile looks like. If you think about this, if you have a bar chart, and we already said a bar chart has 4 data points, right? Open, high, low, close. When you look at a profile that is two-dimensional, it is going to release tremendous amounts of information. Now, not only do I still have the open, high, low, close on this, right? But I now get some performance figures. I can see how much time, the more letters out here, the more time that was spent here, I start to get some idea of how much time was spent at each price. How much time was the auction down here? It was rejected pretty quickly. At the top, it was rejected pretty quickly. So I get tremendous amounts of information that I didn't have before. Remember, initially, with one dimension, open, high, low, close, that's really what I was dealing with. Now, tremendous amounts of information. That, to some people, is a negative. Sometimes, if you can't process basic information to begin with, giving you more information is not necessarily a positive. You have to really be able to learn to use the information, which means you're probably going to have to get rid of some other information in order to make room for this. So on its surface, while it intuitively may sound good that more information is better, it is not necessarily true. You have to use that information very intelligently. Okay, let's work forward, and we see now the graphic is just, the analogy is to putting the pieces of a puzzle together. As you go through this, it's piece by piece by piece. I would guess if you're really pretty sharp, it's going to take you probably a good year to start to get a foundation of how all these pieces begin to fit together. We have a saying, and you'll hear it again, and you'll see a slide on it later. No real learning starts until you can put that information within some contextual view. Give me an idea. Most people, it's always amazed me, I will get a tremendous number of clients that have been very successful in business. In business, if you raise the price of your product and your volume drops off, what do? You're going to lower the price, right? You raise the price of your product and the volume drops off, your market share drops off, you're going to lower the price to get back your market share. Those that have been in business, if you raised your price too high and your volume dropped off, are you going to get your market share back by just going back to the original price? Probably not, right? You're probably going to have to lower it below where you were initially in order to get your market share back and get your business back. Now, sometimes we can see that by actually lowering the price, or we can offer discounts. 0% financing, $500 cash back. There's all kind of ways in order to adjust the price in order to get the demand that you want. That same kind of thing takes place in a market. So let's talk about this idea of context. Many people, when they come out of business, they understand context tremendously. They understand price, they understand volume, yet they will turn around and start to trade stocks and futures, and they will focus mainly on price. They don't pay attention to volume. If I raise my price and my volume drops off by 20%, guess what? In business, I know immediately that's not very healthy. The structure of what I've done with that price isn't going to last very long. Does that mean I won't sell anything? No, I'll sell something, but it's not going to be the same thing. Or if I raise my price, if I raise the price and I actually do the same or more volume, does that give me information? That gives me a whole entirely different context. The best example that I can think of is years ago I used to be amazed. You'd watch interest rates. And if interest rates were coming down, all of a sudden people would be looking and say, well, I'm not going to buy the house right now because I think rates are going lower. So, it's going lower and lower, and all of a sudden, finally, the Fed tightens the rates and the rates start to go higher. Well, theoretically, as the rates go higher, theoretically, that should cut off the activity, right? But in fact, if you're coming from this low level, when you raise the rates, does that cut off the activity? No, they come clamoring into the market because they're afraid that the rates are now going the other way. So higher prices bring in even more activity because people are afraid they're going to miss the market. Now think about this in the stocks and futures market. The price goes down, and you're not going to buy, right? You're not going to buy. The market's going down because it's going lower, right? All of a sudden, it starts the other way, and you start paying more and more and more. Something you could have bought for 7 yesterday, you're willing to pay 9, 10, and 11 for today because you're caught in this auction process and you want to make sure you don't miss it. That's all part of the contextual view. So I want you to think about those things, those pieces of the puzzle. Now, for those that are new to this process, let's talk about the construction of a market profile. First of all, each letter, and you'll see how the letters are formed in a minute, each letter is called a time price opportunity, TPO. It is just simply a way to record the data. It means nothing more than that. It doesn't make any difference if it's an A, a B, or a C. Okay, let's take a look at the next step in how we start to put this together. Initializing the initial balance, or when we put this together, on the way we have done it here is each period is in 30 minutes. So for example, if a market, the S&Ps open at, I believe it's 8:30, we're in Chicago, I think they open at 8:30 Chicago time. So for the first half hour of trading, we might use the letter A. So every time it trades at a given price, we just put a letter to show that we traded at that price. The second period would be B. All we're doing is recording every time the second period trades at a price. Then you've got C, etc. So it goes on. So we traded at this price in only one 30-minute period. We traded at this price in 3 30-minute periods. And this is the profile, how it starts to form. Or if you think of our puzzle, it starts to put the left edge to the profile. And then you'll see that the dimensions or the dynamics move to the right. Okay, the structure, this is what we refer to as the structure of the market, as we record this information, we start to see the structure forming in the marketplace. For example, we talked about the auction process to begin with. If we traded down here, this was the second period low, and the low of the third period, C period, was up there. What happened when prices were going lower? You're advertising for what? You're advertising for buyers, right? Did they find buyers? They found buyers down there, and they were fairly aggressive because the next period, that's the lowest price traded. You now have some type of information about the marketplace. You auctioned low enough, you got the expected return, and the expected return was to find buyers. Now, the auction, here's the auction, and now you see the auction starts in the opposite direction. So it tried to go lower. That auction, we said it's a two-way auction process. It tried to go lower. It got the expected response. The expected response when you go lower is to find buyers. It found the buyers. Now the market's going higher, and as the market's going higher, it's advertising for what? It's advertising for sellers, right? And it goes up until it can find those sellers. That's just, we're going to continue to work on this, but that's just kind of the process. I want you to relate it. I want you to relate it to the auction process. Think about the two-way auction process, and start thinking about, we organize data in order to gather what? When we organize the data, what do we want from that data? Information, right? Now, we call that information market-generated information. Now, have I found any information right here? I found information. I found that there were buyers at that level, right? And guess what? It's not somebody's opinion. It's not somebody on the news telling you anything. This is real. This happens with real people with real money, and that's what we're recording. It's not somebody's view on the tube or a talking head. This is supported by real money, real activity. Now, as we go on, we're going to want to know how much volume was here, how aggressive it was. Let me just ask you a business question. If, in fact, this low price down here was a good price, how long should that price have been there? Momentarily, right? Now, let's say we get down here and we get a, and if it's only there momentarily, how much volume should there be? Very little. It ought to move away from there very quickly. All of a sudden I get a lot of volume. It's there a long time. You have a whole different context. Okay, let's continue on and to see how this develops. We have, let me go back one slide. I talk about something in here. Initial balance. Initial balance is really the first two periods of the day. Now, it doesn't have to be an exact definition, okay? Initial balance is just something we're saying when the market opens in the morning. What is really, how are people seeing the market? They auction a little bit lower, they find some buyers. They auction a little bit higher, they find some sellers. So you have a little bit of balance in the morning. It's not an absolute type of thing. It doesn't have to actually be two periods. It is just to give you a foundation. Once you have that initial balance, then what you want to see is as the day goes on, are you getting outside of that range? So if your initial balance, let's say for example, was from 1 to 10, and then as the day goes on, you start trading at 11, 12, 13, 14, so you're going beyond the initial balance, you're extending that range, and who's extending the range? Is it buyers or sellers? it's going to be buyers that are extending that range to the upside. So again, it releases more information about what's going on in the market. Okay, let's take a look, and this is what we would call range extension. So we have the first two periods, A, B, in this example. So the first two periods would be our initial balance. Now the market extends down in C period. When it extends down in C period, okay, it found, as we talked already, it found what? It found buyers. Now, once we find the buyers there, the market starts to trade back up. When it starts to trade back up again, now it's going to start searching for the other end of that initial balance. Does it have to get there? No. But it's get this idea of the flow of the auction process. Okay, let's kind of move on. We've just talked again, another piece of the anatomy or the description would be called a buying tail. Okay? A buying tail is nothing more than a way to say that the buyers were what? Aggressive? They were very aggressive at that level. So, a 2-tick buying tail, 3-tick time tail, 4-tick buying tail, all is a different measure of how aggressive the buyers were at that particular level. Again, that's information. Now, let me stop for a second. What happens when people are first looking at this information? They want to run out almost immediately and look for a stock or a future that has a buying tail. Oh boy, I mean, I did this. When I first started to learn about this, I would go out and I would look for something, a buying tail. Oh, I've got aggressive buying in there. And if I didn't have a buying tail, then I found myself unwilling to buy because I didn't have the sign of the aggressiveness of there. This is one data point. It is one piece of information. It is not in context. We're very early in this process, but let me complicate this. What does it mean if there is no buying tail? Okay? It may mean several things, and this is when we talk about it takes time to understand this information and to be able to use it effectively. Sometimes, if a market is too short, we've all heard the phase that a market is too short to go any lower or too long to go any higher. Sometimes there's so many people that are short the market, that have sold the market short, that every time the market goes down, they're buying to cover their short. So the market may be weak, but it may have to rally before it can break because you have to get some of that inventory. When markets are too short, it's nothing different. If you think about a business, it's nothing different than saying that a merchant has too much inventory. In this case, the traders have too much short inventory, and that inventory has to be balanced. The same thing on the upper end. Sometimes we say a market has to break before it can rally. Sometimes it's because there's too much long inventory up there. Too many people nervous and they're looking for places to sell, or in the bottom, looking for places to cover their short. That's inventory. Every trader's got an inventory. You can come in the morning with zero position, you have zero inventory. You short a contract, you're short one. You buy one, you're long one. That's your inventory. You start taking that in total around the world, and all of a sudden, you can get huge inventory imbalances. So one of the things you'll learn later on, and comes with cumulative experience, is you find out there's also information in when there is no buying tail. Anyhow, We're not here to talk about that now. All I'm trying to warn you against right now is that it is not as simple as it looks. I think about the time when I was in the service and the first class we had on hand-to-hand combat and martial arts and things like that. And I remember the Sergeant Montgomery saying, "Gentlemen, let me warn you, if you go out in the bars tonight, you don't know enough to really put this to use." Of course, we were fast learners, right? So we go out the first night. We're down in one of the Navy SEAL areas, down in the southern part of the country, and we got wise marking in a bar. And guess what? We learned very quickly we did not have enough information at that point in time to compete with some of the Navy SEALs. I did come out alive, but it was not the pleasant experience. I had some unpleasant experiences here early on. Okay, let's move on. Okay, we talked earlier about a buying tail. Now we come up and we talk about a selling tail. It's just the mirror image. Again, it's information. The longer the tail, the more aggressive the sellers were at that point in time. That is a very valuable type of information. And as you can see, as the day develops, you continue to get dimension to the profile. Okay, let's continue to look at the anatomy. Down here, picture before we had the C period. Down, and we circled this so you were right here. When you don't have the buying or selling tails, what we're saying is the puzzle at this point is not yet completed. Very key piece of information. For example, you will see some days where you'll get right there and you have ABC. The market will rally from that level, and a lot of times this may turn out to be a previous day's high or low, a very mechanical point that traders can very easily see. So you'll see the market rally from here. What it does, it changes the odds of the market going higher. It may bounce from there. You may get some short covering from there. You may get some traders mechanically buying at a previous morning low or daily low. But the fact that the auction is not complete here lowers the odds of your success to the upside. Very often what you'll see is not completed. You'll see it bounce. Then you'll see it come back a second time and actually complete that auction process. Again, it's going to get more complicated, but it's just a piece of information, but it helps as we go through this, it helps compute the odds of being long, being short. Trading is about understanding the odds. Most people have no idea when they're trading what the odds they're dealing with are. All they want to do is they're so emotionally involved, they just want to buy something lower, sell it higher. They have no idea that the risk they're taking. The other day when the market dropped 1,000 points at one time, we were talking about poor structure going up. Most of the people had no idea the risks that they had by being long the market. When you look underneath the market, there was weakness in the structure. Would I have predicted that? No, I wouldn't have predicted that because it was far beyond 3, 4, 5. It was probably an uncalculable event. It's probably a 50 standard deviation move when you had a break like that, which may be equivalent to the odds of that happening in our lifetime are probably, minuscule. But the odds of having something bad happen were much greater because of the fact of the underlying structure. And we'll continue to come back to that. Okay, let's look at more pieces that go into the puzzle. I talked earlier about the point of control, and this will be a very important concept for you to deal with as we go through this. Technically speaking, when you look at the market profile, the point of control is the longest line reading from left to right of the daily profile. It's the longest line, means it traded there in the greatest number of half-hour periods. Incidentally, we use 30-minute periods to construct the market profile. That's on when you go across the horizontal line in the bottom. The first period would be 30 minutes. So if a market opened at 9:30, the first period would be 9:30 to 10. The second period would be 10 to 10:30. It doesn't make any difference. You can use 5 minutes, 15 minutes, an hour. You can do it with a day. You can have each period being a day. It doesn't make any difference. One of the important points that I want to make here, when you go through this, the concepts that we are talking about, the organization of the data, the way the market works, if it doesn't work for all time frames, and we haven't really introduced the time frames yet, but you can quickly understand that there's people with very short time frames and people with very long time frames, day traders, people that are going to buy for months. The concepts are exactly the same, whether it's 5-minute time frame, 30-minute time frame, daily time frame. All markets that are financial in nature should operate in exactly the same manner. We'll talk about that more as we go. The first we had was the point of control. It's the longest line closest to the center of the range. That's the technical definition. But what I want you to really appreciate more than anything else, it is the fairest price at which business is being conducted. If I'm looking at a graphic, a profile graphic for a particular day, the longest line closest to the center of the range is the fairest price at which business is being conducted for that particular day. That is extremely valuable information. As you see price move away from the fairest price to the downside or move away from it on the upside, let's add some context. If the fairest price is moved right here, and now you see price start to auction higher to get away from the fairest price, what would it take to change the fairest price? This is formed by time, right? So if I spent 5 periods here in the middle and then 4 at the next price, it would take time in order to raise or lower the fairest price to conduct business. But if I start to move away from the fairest price, okay, or another way to say I have price moving above value or above the fairest price, and let's say it's on low volume. If I move away from the fairest price to do business on low volume, what do you think the odds are that that price change is going to be maintained? If I moved away on lower volume, not very good, right? No different than a merchant or a manufacturer raising the price of a product that they're offering and having the volume dry up. The chances are you're going to get regression back to the mean. The same thing if price goes lower and the volume dries up or diminishes, the chances are you're going to get pulled back. Now, let's talk about a different scenario. My fairest price to do business here, and then price moves higher. As it moves higher, it's going on increased volume. What do you think the chances are now? You see how the odds change? It may get pulled back to this, but the odds have lessened. If I'm moving higher away from the fairest price on solid volume, the odds are less that I'm going to regress back to this level. Again, this is all part of the context, and we'll continue to work on this. The point of control, or the fairest price to do business, will migrate up or down throughout the day. As you look at the profile, you can see another way to describe the market profile. It is a time-sensitive, real-time, time-sensitive, evolving database. It's alive, it's dynamic, it changes throughout the day. We said each one of those letters is the TPOs. As the TPOs change, it's dynamic, it grows with you, it grows with the market. There's absolutely nothing static about it. The migration of the point of control up or down throughout the day, in other words, if the fairest price to conduct business migrates up and down throughout the day, that is also generating very valuable information. If in fact you start to see the point of control migrating lower throughout the day, what is causing it to migrate lower? Is it because of buyers or is it because of sellers? And when you're on the floor of exchange, this means buy, this means sell. If you have a point of control migrating lower throughout the day, that means that you have somebody selling into the market. In other words, what they're probably doing is on every rally, you probably have some bigger money saying, you bought some, they let the market settle, it comes up again, you bought some more, be very subtle. But all of a sudden, you see that fairest price at which business being conducted migrating lower. Then, all of a sudden, what you'll see sometimes is you'll just see the market give way, and you'll see a big spike to the downside, because all of a sudden, it started out very subtle, right? You know, if you're really a smart seller and you've got any size, you want to disguise your intentions as much as you can, right? You really want to disguise it. You don't want the world to know what you're doing. If you're Fidelity or Magellan or somebody, Invesco or somebody like that, you don't want to advertise what you're doing. Matter of fact, it's not uncommon for these people to spread their orders out or do everything they can to disguise them. So all of a sudden, you see this point of control or fairest price to do business migrating lower. All of a sudden, the world wakes up and they said, uh-oh, we've been had. And then you'll start to see a very fast break in the market. That's kind of a realization. One of my favorite stories, I talked about years ago when I was on the Board of Trade. There used to be a guy down there. He was a hedger for one of the Minneapolis grain companies. And that was so many years ago. That was a $500 suit, was a big deal. But he was very nicely dressed, coat was always buttoned, and he'd be standing there, like this, talking to somebody, and all of a sudden the market would move, one of the grain markets would move up or down, and he'd very politely excuse himself. He'd walk into the crowd, and he'd either be selling or buying. Well, the crowd knew, the folks on the floor knew he represented size, and all of a sudden the market would go crazy for a while. Then he'd walk back over, his hands back behind his back, and he'd go back and engage in the conversation he'd been in before. Those people, that happened to be a very visual example, but those people exist in big size. They come in, they're opportunists, they come in when markets are at attractive levels for them of what they want to do. And nobody's going to tell you that, right? Nobody's going to tell you that, but as you learn to read the data, you start to get a better sense of what is actually transpiring in the market. And that's where we use the market profile graphic, multidimensional. It is a time-sensitive, real-time evolving database. Okay, so let's move on with some of our terminology. What are we looking at next? The point of control is migrating lower, and we're looking to see as price moves lower, it's advertising for what? It's advertising for buyers, right? in any business, the important thing to have happen is to find a place where what can take place. Two-sided trade. I know this gentleman works for Ford. Unless there's two-sided trade that takes place, Ford's not going to sell anything, right? So that's what business and price discovery, you're looking for those levels. But you want those levels to be fair. Now, let's take a look at what's going on here. We saw the price, we saw the fairest price to do business initially migrate a little lower. Now, when the market breaks late in the day, the fairest price in this example did not migrate lower. The fairest price did not migrate lower. So you're coming down here, and the fact that it didn't migrate lower is also a very valuable piece of information. We talk about situations where people get caught short in a marketplace. When the point of control doesn't migrate lower, but price goes lower, and it may be because there's some rumor, somebody said something on CNBC, and everybody's going to sell, or it hits some technical level that brings in all kind of sellers, and you're looking, if you're looking just at price, and most people cannot trade successfully because they are too trapped by price. They can't put the price in context. But you look here in this example, price goes lower, it's trying to find a place for two-sided trade to take place. It's advertising down here for buyers, but the fairest price to do business is up here. When this kind of situation happens, how many people have heard the term short in the hole? When you talk about somebody, market people being short in the hole, all that means is you're being short, you're getting short at bad prices. That's common parlance that you hear for years around the trading community. When you get people caught short in the hole, it means they got emotionally trapped, they got short at very bad prices. And at that point in time, watch out, you have a potential disaster on your hand. So this clue up here, the point of control is not going lower. Let's take a look at where we go next with this. And the people that know me know that I prefer to talk about things that have actually happened and that I've written about or put out notices ahead of time, because I don't like to ever be thought of as cherry picking, trying to find examples and say and make it fit. In this particular day, the point of control, this is real. You see this going down. It's not uncommon to have this line be almost a 45-degree line. Don't make it exact like that. But in the last 4 periods, price is trading lower, but the point of control is not migrating lower. Traders are getting short in the hole. Look at the point of control. The date was April 21st, 2010. Okay, let's take a look what happened. This is an email sent at 2:51. I advised 2 hedge funds. I advised 3 trading companies in Chicago and 2 hedge funds. This is the email sent, and you can see the time and the day. Look at the POC not migrating lower. Sellers are getting caught short in the hole, 45-degree line. And then I say here, no outside event, and we could be setting up for a rally, meaning no outside event, no exogenous event, no unexpected announcement. Okay, so this is actual. There's the date that's going to be reproduced. Let's back up for 1 second. Look at the profile. So you see the profile, you see this thing setting up. Now imagine yourself as a trader getting caught here, because what is price doing? Okay, Price is just going lower and lower and lower. A lot of traders, what happens, a lot of traders that got on short early in the morning, and let's say this thing's going down, they love it, right? And Keith, what tendency might you do at this point? You start pressing it, right? You got, and I know because I've seen you trade, you start off here and you're pressing it, you're pressing it, you're pressing it, and it's feeling pretty good because price is going your way. You're patting yourself on the back and sometimes not recognizing the trap that is building. Okay, there's the K period, there's the low. We make the low, point of control didn't go. Look what happens late in the day. We rally all the way back to the point of control. The value area, again, we introduced it briefly earlier. It's where approximately 70% of the daily trade takes place. Okay? And there's nothing magical about it. It's just a way to think about the market and to think about price versus value. One of the things you'll hear from us consistently is we trade value, not price. The day we're seeing followers completed, the profile graphic reveals the value area. This is calculated for you. Terry, are you here? Terry is back there. Terry Lieberman owns a company called Window Trader. We get these, we use Window Trader, and it calculates the value area for you. As you become more efficient, you will start to visualize what the market profile will look like prior to the end of the day. Now, when we're talking about really becoming a successful trader, one of the things we say is visualize, don't predict. So for example, you've had just a little introduction. Let's say that we have a market that opens and it's got a pretty aggressive buying tail right off the opening in the morning, and the market starts to auction higher. Okay, you start to visualize this is a pretty strong day, and you start to see that this market's moving higher. You start to visualize what the profile is going to look like. Now, you're not at that level yet, but this is ultimately where you want to get to. The faster you can visualize what the completed profile is going to look like when the day is over, the better you're going to be able to position the trades, the better you're going to be able to control your risk in this whole situation. So this is the goal. This is just kind of a normal profile. We don't get many of these. But we're just using it to keep bringing the idea back. Okay. Incomplete auctions are revealed through the profile shape. Here we have the low made early. The D auction opens and begins to completes the profile. Look over here. That would be your initial balance and just a little more. As you get more comfortable with the profile and you get more comfortable with the range of a particular stock or future you're trading, all of a sudden you may look at a very narrow range like this and you say, wait a minute, it's highly unlikely that the range is going to be that tight for the remainder of the day. So if you see this and you look at this example, you have a buying tail, you don't have any completion up here. Now, it's not always completed, it doesn't always fit perfectly, but you look at this, you see that the buyers were more aggressive than were the what? Than were the sellers, right? So now you say, wait a minute, let's take a look at what's going on here. Unlikely we're going to hold that balance. So the first thing you ought to be thinking about is opportunity. I was thinking about, wait a minute, is there an opportunity setting up? Years ago, when I used to advise a lot of the folks on the Board of Trade, I used to say, when you saw a quiet market like this, Here's what the Board of Trade guys used to do. When you had a quiet market like this in the first period, they'd go out and have coffee, right? They'd go out and have coffee. There's nothing going on. Same thing happens to me. I'm in front of the machine, nothing going on. I go down and make some cereal or something. No. When you've got this, my statement ought to be, guys, do not go out for coffee. The hair on the back of your neck ought to be standing straight up, because there ought to be a significant opportunity beginning to develop here. It's unlikely you're going to hold that range for the day. So we have a buying tail on the bottom. We don't have anything earlier. One of the slides you saw, when you don't have a selling tail, you have an auction that's not completed. Not as simple as that. But then, now you look and you say, wait a minute, what happens? We introduced a term earlier called range extension, okay? Now, what happens? The market's creeping up in here. You had some evidence of buying early, not completed. All of a sudden, in the D period, the market comes to life. We come out of this narrow range. And, as we would say, the market goes bid. All of a sudden, the market has come in, the bidders are there, price is going higher. And you can see D period, E, F, G, H, I. Let me introduce this term right here for a second. We have a term that we call one-time framing. One-time framing is nothing more than when one period, let's say it's one-time framing up, one period does not take out the low of the prior period, does either stay within the range or take out the high. So the market, the auction starts here, pretty aggressive, and remember, I can split these profiles out at any point. You've seen completed profiles, but I also can split them out. So when something changes here, it gets aggressive, there we go. The D period, did E period take out the low of D period? No. Did F period take out the low of E period? No. Did G period take out the low of F period? Did H? No. I? No. Okay, and J did not. You came up and balanced in J. So for 30, 60, 90, 120, 150, you can go on up, that once the market got started here, the market one time framed up for all the way through the J period and close to the end of the day. I was shocked, as this has always been a very natural thing to me. I was shocked the first time I had a room of probably 50 to 60 professional traders, and I asked the question, how many people understand what one time framing is? And I got one response. I was shocked, because it is just such a helpful thing to know what is going on, because what happens if you understand this, you don't fade. And fade means going against the market. So in this direction, the market, the auction's going which way? It going's higher, right? The biggest single mistake that traders make is fading a trend day or fading a market that's one time framing higher or lower. Now, you fall into the trap because it was quiet to begin with, right? You fall into the trap, the market's going higher, and you think, oh boy, you know, if I could have sold this thing at 10 this morning, I didn't, but boy, at 18, it looks like a real sell here at 18. Intuitively, you just say, oh boy, I gotta sell it here. We're programmed to think that that's less risk. And it actually, if it's one time framing up, you're taking a tremendous amount of risk. Intuitively, you don't think that. You think, well, I've got less risk selling something at 8 than I do at 6. Not necessarily true if the market's one time framing up. When you see something like this, one of the things you're trying to learn to do is just go with it. We make more errors by outthinking ourselves, by fighting against what the market's actually doing. And it doesn't make any, we've got a room of people here today that run from extremely experienced to very inexperienced. But I will promise you, because I know an awful lot of very experienced traders, we make the same mistake. We get it in our head that something's not worth something, and we sit down there and we do something like this. The day is over and we look at why we weren't successful, and we say, how in the world could I have done that? Because we got something else in our mind. We weren't objectively looking at the market generated information. Do not short a market that's one time framing up. Anyhow, we get off in tangents, but that's all right. We take the completed day, we started down here, we had a buying tail, we had an uncompleted profile, a very narrow base. They came into the market, and all of a sudden, the auction started to go higher. Now, there's a lot more information in here. There's a lot more information. But I just want you to kind of get a feel of what's going on. And introducing the phrase of one time frame. Let's kind of continue on with our example. Again, you've heard this before. In the old days, when I used to have a discount futures firm, J.F. Dalton Associates. And in those days, there's most of the early business, and there were a lot of floor traders on the market. The really good floor traders developed a skill, and that skill was listening to the market. Okay? If you went up to yesterday's high, and we all know that floor traders might play games. What are you going to have at yesterday's high? You're going to have stops. Okay? A great game for the floor trader at that point in time was to bid the market up to get the stops. Once you get the stops, you force people to buy. If you're a floor trader, how do you profit from hitting the stops? By selling into it, right? You bid it up, you force the stops to cover, you now sold. All right? Now, if that's as simple as it was, what would happen? The floor traders would bid the market up. They would hear the level of the orders are coming into the pit, or what we call the outside flow of orders, or the lack of outside flow of orders. So the market comes in, you take out yesterday's high. This, I said, means buy on the floor. So you go up, you take out yesterday's high, you hit the stops, and all of a sudden it gets deathly quiet. It gets deathly quiet. What does that tell you? There is no more flow of orders from the outside. So the good floor trader intuitively went from buy, hands out means sell. He heard the market. He heard there was no outside flow of orders. Okay, gave him a tremendous advantage. Now you take out yesterday's high and the level of volume increases tremendously. So higher prices, instead of cutting off activity, the level goes up, the bids are coming in. So that's bringing in more orders. It gets very noisy, keeps bidding, but they heard that go on. Okay, now the floor, so much of the business on the floors has gone away. That advantage to the floor trader is gone. My single biggest client base has been among floor traders that were transitioning from the floor to learning to trade upstairs off of electronic screens. It's a totally new business to them. They lost the ability to hear what was going on the floor of the market. When that happens, and when you're learning to trade from an electronic screen upstairs, what you start to do is you start to replace hearing with understanding structure and how structure builds in there. The structure is your way. In other words, what you used to hear, you now develop an ability to see. Some of the more experienced floor traders, they could tell you, for example, right down here in the low, if this is the opening price, they could tell you if this was the low, they could look at it, they can't hear it anymore, but they can still hear it in their mind. The bids were pretty aggressive. So now I just want to look at some ideas of structure. We're not going to cover this in any detail just yet. But when I see a structure that goes thin on the bottom and it starts to look like the letter P on top, okay? If you don't know anything about what we're talking about, it doesn't mean anything to you. But from experience, I know that when I have a P shape in the structure, that is an indication that I have short covering, okay? Another way we refer to short covering is old business. In other words, the people that have already been short, how do you cover a short? If you've been short, you have to buy in order to cover that short. That is old business. You're closing out something you already had. Versus new business. If you came in to buy something for the first time, that would be new business. To visualize structure, if you had a market started out like this at the bottom with a relatively thin structure, and you had a combination of short covering, and almost all rallies begin with short covering, and they had that short covering joined by new buying, so you had old business combined with new business, then more than likely what's going to happen to your structure, it's going to elongate out because you've got two different kinds of business coming in. When your structure doesn't elongate and you start to get the formation that looks like the letter P, you had old business. The old business was coming in, people were covering shorts, but it wasn't joined by new business. When you look over on the right side, let's go all the way from the left to the right, let's take the mirror image of short covering, would be long liquidation. So let's say you have traders that have gotten too long, for example, momentum traders that have gotten too long, and all of a sudden the liquidation starts, but it's liquidation not joined by new fresh shorts in the market, it's just liquidating a long position. You tend to get the mirror image of the P formation, which is the letter B. Okay? Now, again, there's not enough information for you to take and use yet with that, other than to increase your understanding of what is going on in the marketplace. For example, here's a tough one that most people have a lot of difficulty with. Does short covering, after the short covering is completed, does it strengthen or weaken a market? How many people think it strengthens the market? Okay, and how many people think it weakens the market? And how many people don't know? Okay, short covering, when the short covering is over, it actually weakens the underlying structure of the market. Because if somebody's short, what do they have to do to cover their short? They have to buy, right? And once you take that buy inventory out of the market, you've actually weakened the underlying structure of the market. It's only one data point, but it's something to remember. When you have long liquidation, okay, when you get the long liquidation, again, it's kind of the mirror image. Again, we are just touching on concepts. There's far more to it than this. I'm just kind of walking you along to get some idea of the importance of understanding the structure of a market, and that there is structure to a market. Just as there's structure, if you go to Sotheby's for an auction, there is structure to the way that auction is handled. They have rules, they have regulations, they have a procedure for that auction. Any auction you go to will have some kind of structure to it. Now, the day in the middle, the structure in the middle, the two books you should read, I've written two books. The first one was called Mind Over Markets. And that's Mind Over Markets, the first book, is more linear. Traders seem to enjoy that book more because it feels more linear, it feels more understandable, the definitions aren't as ambiguous in it. The second book is called Markets in Profile. Okay? The best book is actually Markets in Profile. It's more ambiguous, it's harder to understand, but guess what? The harder it is to understand, the fewer people that are going to stick with it, the greater the edge that you're going to get with it. You need to read both books. But the first book is more mechanical. We've changed the terms. When I wrote the first book, Mind Over Markets, I basically used the terms that were introduced to me by Pete Stottlemyre, who introduced this concept to begin with. As I got more experience, I'm not as comfortable with the terms, so I've renamed the terms. The first term to start with is what I call a primary day. In other words, when I call it a primary day, it's a day that we have a tendency to see more often. It's a more common type of day. In this day, you'll see the high was made in B period. You see the point of control in the center. You see a little bit of range extension to the downside. It's kind of the day I use to measure other days against now. While we're at it, it's a nuance. One of the things that you'll hear from us multiple times is the importance of nuances. Nuances make a huge amount of difference. Unsuccessful traders have a tendency to skip over nuances. You ever have somebody that's not telling you the truth? They tell you a story. They look in your eyes and they just intuitively know that you didn't quite buy their story. What do they do next? They kind of repeat themselves, right? They kind of repeat themselves. They kind of tell you the story again, and they put just a little bit of different twist, on it. And there's information in that. And you start to read that kind of information. Is it real? Are they telling me the truth? Aren't they telling me the truth? You need, when you look at the market, you need some way to judge, is what you're seeing in price the real truth behind what is going on in the market? So many times the information is in a nuance. Just as the person that didn't tell you the truth tends to talk a little bit more and tends to repeat the story, the nuances, they're probably not telling the truth. Nuances do matter. Nuances separate out the winners and the losers. I always like the example. I had a very good friend when I was in the service that really desperately wanted to be a professional football player, and he played for Xavier. And he said, Jim, he said, I think what kept me back, he said, I was probably just a fraction of a second too slow to get through the hole. He was very well built, very athletic, but he said just a fraction. And sometimes it's just a fraction that makes the difference between winning and losing. So nuances are important. Being able to look at a particular day like this and have some base against which to judge other nuances is very important. Side, while we're on here, very minor, but if you go back, and I don't ask anybody here to take what I say for granted. I want you to take it back, study it, and make the evaluation on your own. I'm going to guess, and I've not done this mathematically and systematically, I'm going to guess that probably about someplace in the order of 75 to 80% of the time, the high or low of a day is made within the first hour or so. In this particular day, we have A period, B period. The high was made early in the morning. We didn't set this up, I just looked at it right here. The low was made early in the morning. Up there, the high was made, not a completed high, but it's made early in the morning. But it's just something, it's a nuance to go back, look at, and think about. There's very valuable information in some of that. Now, price will mess you up throughout the day. You'll forget about that. But if you keep that in mind, it can be very helpful. Okay? Just an idea of some of the structure. We look here, one of the things that we talked about earlier, here's April 9th. We see the market break. This was a Friday. This market was absolutely dead quiet until very late in the day. And I hope somebody will tell me that's a Friday, I'll probably remember correctly. And late in the day, the market broke to the upside. The following Monday, the market remained within that upper section. When markets make big price moves up or down, it usually takes some time to process before it reverses itself. Here's what's important. This structure, remember earlier, we talked about to get away and remain away from the fairest price in which business is being conducted. Is it more than likely going to take volume? What if it moves away from the fairest price to conduct business, but it's not on volume? The chances are that you're not going to be able to hold that. The same thing, we're a gentleman from Ford. Ford raises the price of the new Ford Focus. They raise it too high. Guess what? They're not going to be able to hold that level. You'll get some financing break or some cash back, but sometimes they're not going to do it immediately, right? If a manufacturer raises a price that's too high, he doesn't get the information the next day. Sometimes it may take a few days or some time to sink in. The difference is everything happens exactly the same way. In the markets, it seems to happen far quicker sometimes than it does in a manufacturing organization. But this day, the market was not elongating out. It probably caught some shorts, some game playing late in the day. The market went up on low volume. We held that volume on Monday, and take a look what happened on Tuesday. So we came back down, and remember the early slide I was showing you, I used a term called repair. Early on, I was saying, here's one of the things we're going to get to by the time we get through the seminar. When you have poor structure, and this is poor structure, there's no elongation, that didn't go up on good volume, you balanced on the following day, and you came back down, and you repaired this structure. So this whole thing was corrected a couple of days later. Now, here's what happens to traders very often. They don't have the patience to recognize that this is an opportunity that is setting up. But that opportunity may take some time to develop. But let's talk about odds for a second. If you're lucky, let's say you're lucky and you caught this spike late in the day, you got the spike to the upside and you caught it, and when you go home on Friday and you're long in your profit, how do you feel? You feel pretty good. You know, you're walking around, you're kind of bouncing around at the top of the world. This is pretty neat. I'm a pretty good trader. You kind of pat yourself on the back. Oblivious to how much risk that you really have. One of the things that we talk about with traders, and when I first say this statement, I can look in the eyes of the people I'm talking to and I can tell if they have any idea what I'm saying or not. I can also have a pretty good idea their chances of success down the road. Most people are trading and their objective is just to make money. Okay? Can you manage return? You can't manage return. The markets, whatever the market does, you can't affect that. It's going to do what it's going to do. You cannot manage return. However, you can manage your risk. You can manage the risk you take. If you learn to manage your risk, which you can manage, but you cannot manage your return, all of a sudden you have made a huge breakthrough. I said earlier, I advise 2 hedge funds. One hedge fund been profitable for 10 years. They got hurt in the break a few years ago. First time we had lunch, they wanted to talk about, kind of getting the business rebuilt. We talked about it, and I made this same thing about you can manage risk, but you can't manage return. I could just see kind of the blank look at the lunch, what was going on. One of the principals of this firm was a basketball player for Utah. Very knowledgeable, very intelligent trader. But it really didn't sink in at first. We talked about this about a year later. I get a copy of a letter that he sent to his partner. His partner identified me and brought me in. He said, the best thing you ever did to us was introducing Jim into the equation. He said, because it didn't make a lot of sense to me at lunch when he first said it, but it's made all the difference to how we manage the money and to our return. It finally got what he was saying is that we can manage risk. And where we got hurt the first time, we weren't managing risk. We were after return. He said, now we know how to manage risk. And he said the return is falling into place. It took a while for that to sink in. It was a very sincere compliment. This guy does not pass out compliments for anything. It took a period of time for it to sink in. It took a period of time to restructure how the entire fund was managed. But it all came down to managing risk. Now, I got another notice from him the other day, and I may have the numbers somewhat wrong, but when the market was down big, over 1,000 points and ended up down, about 300-400, the market, I think, was off someplace in the 3% area. And if I remember right, their fund was off 0.4%. That's a big change. You talk about managing risk, and that came about because when this exogenous event took place, exogenous just means something that's outside of anybody's model for running their portfolio or running their account. When this exogenous event took place the other day, because they had managed risk, their loss was minimal. If you're running an awful lot of money and you start to get a couple % difference in that's big money. Talk about managing risk, and that came about because when this exogenous event took place, exogenous just means something that's outside of anybody's model for running their portfolio or running their account. When this exogenous event took place because they had managed risk, their loss was minimal. If you're running an awful lot of money and you start to get, a couple % difference in, that's big money. And it has a lot to do with your longer term performance. Now, let's complicate this, right? If I take this example right here, and I say the structure wasn't elongated, I got a pop late on Friday afternoon. I don't think it's sustainable. I get a balancing day on Monday, which is very common after you get a big movement like this. People don't know and they just kind of hold that level. And then it comes back and I say, okay, we took all that back on Tuesday. So far, not terribly difficult to comprehend. Maybe a little more difficult if you actually had trades on and you're watching this trade to do, but when you're not emotionally involved in it, it's not quite that difficult. But let's complicate it. On the day that the market corrected, we opened up in here, we came down here, we corrected this, but then we go back up and we don't leave a good high. In other words, what is a good high or a secure high would be a high that had a what? A selling tail on it. A selling tail, when I don't have a selling tail, it's an indication when I got at the highest prices of the day, did I have anybody saying, wow, what an opportunity, you bought some? Okay? Is that a piece of information? We organize under the market profile. We look at the auction process, and in the two-way auction process, there's continual information. Part of the information, we corrected this. There was aggressive buying down here, and notice how close we came down to this low down here. Markets, another thing you'll hear very often, markets are those that have been around a long time, what's the word? Markets are very what? Visual. They're very visual. They're not mathematical. They go to levels that you can see pretty easily. So if you learn to do your homework ahead of time, you know where those visual references are, it will give you a tremendous edge. Julia used the term early on, we're after an edge. Whether it's edge in how we look at the market, whether it's an edge at doing our homework, knowing where those visual references are. So now the market auctioned lower, it corrected this, and it found down here, it found what? It found buyers, which is basically the same low we had there. So it came down there, then the market started doing what? One time framing up. There's your buying tail, one time frame, one time frame, one time frame, one time frame. This does not stop the one time framing. Okay, just because they match, it takes 2 ticks to stop one time framing. So we go all the way up, and I think that's 1 tick. So I think this market until the very last period, basically one time framed up from the bottom. Now, Right here, you saw this once before. You see what is called the afternoon pullback low. This turned into a trend day. It started down, it turned into a trend day, which means the trend, it just went one way from that point on. Very often, late in a trend day, you will get a period where the market settles down and it's doing nothing but adjusting inventory that got a little bit too long. So you see the market go up. Late in the day, you'll see some settling. You may see a little pullback. Market settles, and then it takes off and runs again. A lot of people, first of all, a lot of people get caught as soon as the market starts to settle. They sell into it and not realizing it's just an inventory correction. Then it turns around and goes back up. But the point I want to make right here is the afternoon pullback low. If the market trends up from the C period, goes on up, we balance late in the day. There's the balance, K period, HIJKLMN goes higher. That K period, that pullback low, is a significant short-term reference point for short-term traders. Again, I asked this question the first time I had a room full of traders. I asked how many people know or understand what I mean when I'm talking about the pullback low. The show of hands was 0, and I was surprised. But when it pulls, all that is an inventory adjustment when it comes back in the afternoon, okay? Now, if on that becomes a reference, if on the following day we don't trade back down below the late afternoon pullback low of a big trend day, has anything changed in the market? No, there's been no change in the marketplace. Now, if in fact you don't understand that, you don't understand structure, you don't understand how to look at a market, you may see price going down towards that level, and if you're just trading price, oh my golly, you want to get short. You want to get short this market. You can't wait to get short, and all of a sudden the market turns around and it reps back up to the upside, and you don't understand what happened. That pullback low, all it was an inventory adjustment, and if it doesn't get down below there the next day, all it's telling you is, guess what, folks? Nothing's changed from the late rally and inventory adjustment we had the previous day. Now, at this point, you're probably starting to see how complex a lot of this information can get. You're starting to see nuances, right? Pullback low. People, how many people before you heard it from me had ever heard the term pullback low? No hands? No hands showing, and there's a lot of experience in this group, okay? It's a nuance, right? Do nuances make a difference? Nuances make a big difference. Talked about my friend, maybe just a fraction of a step slow getting through the hole at Xavier. If you can't get through the hole as a running back, you get tackled, right? It doesn't take much to make the difference between being successful and unsuccessful. There are not many successful traders. I mean, when you look at, I don't have the actual numbers, I'm not sure anybody does, but all the anecdotal evidence you look at over the years say that it's a pretty small universe. But guess what? It's a very small universe for surgeons that you want to do heart surgery on you too, right? There's as much money in this as there is in heart surgery. So guess what? it's going to be competitive, and there's not going to be a lot of people that make it and can do that competition. Nuances matter. If you're having heart surgery, do nuances matter? You better believe they do, right? And you think about the ability to trade successfully and adapt. You know, a heart surgeon can look at all the x-rays in the world, but once the incision is made, if it's not exactly according to the x-ray, it's kind of uncomforting. Goes open and opens the book, right? Or calls his buddy. He needs to be able to make that adjustment. And sometimes it's just a little nuance, but that's really a lot of what separates us. Okay, let's continue on. We talked earlier about a primary day. A primary day is kind of a standard day, a day that happens more often than not. A variation of a primary day is nothing more than a day that shows a little more aggressiveness. A little more aggressiveness, and it will generally be a little more directional aggressiveness. Again, all I'm trying to do is just kind of give you a standard and kind of measure against it. We started off talking about the bell-shaped curve, and we said, but you're not going to see many bell-shaped curves. My bell-shaped curve then becomes the primary day. And if you were looking at data and all of a sudden you saw quite a skew to a bell-shaped curve, you would know something was wrong, right? I mean, where were you first introduced to the bell-shaped curve? Probably in a grading system when you went to school. If you're as old as I am, they did those kind of things. But you should have so many people with A's, B's, C's, D's, etc. Well, all of a sudden, if you have no one with A's and no one with D's, you've got a kind of weird skew to that curve, and it starts to tell you something. And all we've done here is we use the primary day as kind of our bell-shaped curve. Then we start to look at variations from that to give you an idea of aggressiveness of the auction. A variation of a primary day is just a day that's a little more aggressiveness in the marketplace. Okay, let's take a look at our next day, or our list of days. So we have the day types. Primary day, variation of a primary day. We have two kinds of trend days. We have a double distribution trend day and a straight trend day. We have a trend day which just goes in one direction all day long. We have a double distribution trend day which you get one distribution, then that's blown away and you get a second distribution. Finally, you have a very balanced type of day. So again, there's nothing magical about it. It's just a way to be thinking about the market and thinking about the structure. Primary, variation, trend days, two types of trend days, and let's take a look at them. Okay. Here's a trend day that the market basically moves in one direction for most of the day. Okay? And those are days, the primary thing, a trader, you do not do what to a trend day? You do not fade it. Let's rephrase it. You're not supposed to fade the trend day. It is amazing how many traders, when I look over their shoulder, cannot resist fading the trend day. I know that's happened to somebody in here. How you should be trading on a trend day is you want to get long as early as possible. When you've got a trend day, and as soon as you recognize a trend day and the aggressiveness of it, get on the trade. Get on the trend day. You then, if you want to do short-term trades, you take profits on rallies, buy it back on breaks, versus shorting rallies and covering on the break. Get the nuance in there. You're already long, trend day goes up, take a profit, buy the pullback, take another profit. What you don't want to do is watch the trend day go up, attempt to sell it, and buy it back. You want to trade with the trend day. You want to trade with the trend day. Now, some people will be smart, they'll just leave it alone and stay with it all day. Most short-term traders cannot leave, they can't bring themselves to leave their hands off of it. And of course, they're always sorry they didn't. I see a couple, you can always tell, you see a couple smiles and you know what's going on. If you in fact are going to short a trend day, you have to be right immediately. This is the third day I've been in Chicago. I was here on Monday and Tuesday. This is a Wednesday. I was here on Monday and Tuesday doing real-time trading with 3 trading groups in Chicago. Some of you were here for that. Yesterday morning, I believe it was the crack spread. The crack spread looked up above a previous day's high, came back in, and we said, okay, it's a legitimate short here. But we then said, we looked at the monthly, weekly, and daily chart, and we said, what is the long-term, intermediate, and short-term auction direction of the crack spread? And the answer I got was what, Joe? Up? It was up, okay? We put the short on, and the short looked pretty good for about an hour and a half. And all of a sudden, I made the statement. You've got to remember, we are short against the trend. If you are short against the trend, you have to be right, and you have to be right very quickly. The market went down for, if I think right, about an hour and a half. I remember it was B period. All of a sudden, it left a buying tail of 5 or 6 ticks. You've already seen what a buying tail is. So aggressive buying came in with the auction. We went back up, took the high, and we extended for the rest of the day. And today we gapped higher. I guess it was a very big higher gap today. Those people yesterday, and I wish we could show that example today so it would stick with you, because it feels so good to short a higher price. We were actually shorting the crack spread at higher prices than we've seen in some period of time. We're very close to it, and it started to work for us. So when it starts to work for you, you're feeling pretty good, right? And we're looking to say, no, wait a minute, we are short against the trend. So many people trade and they have no idea what the trend is. They have no idea what they're dealing with. When that market turned around, the momentum traders came in and it was gone. So when you look at a trend, trading a trend day, you want to trade with the trend. If you can't leave it alone, take profits on rallies, buy them back on breaks. And the trend day, we look down here, we got a low. Did we one time frame? We stopped one period. We stopped one time framing at one point in the trend day. Then it turned around and went the rest of the day. Remember, we said it is not uncommon in a trend day to have one period in which the market will balance. Okay, so that's one type of a trend day. Let's take a look at the second type. The second type is what we call a double distribution trend day. A double distribution trend day will have a distribution down here. And if you were thinking about, if you're thinking about statistics or something, you'd have one node down here or one distribution down here. And then that distribution gets blown away midday or so, and it goes up and forms a whole new distribution. So you're gonna, if you take the total day, you're gonna have two nodes that form that distribution. Let me ask you a question. On a trend day that basically moves directionally all day, or a double distribution trend day, which of those trend days do you think emits the highest level of confidence? The double distribution or the straight trend? It's the straight trend day. So when you talk about thinking down the road, coming back, when the market's coming back the other way, the double distribution trend day has great, I'm not saying it's going to come back, but it presents greater odds that will retrace some of that range than does the trend day that moves directionally all day long. Again, those are nuances. Now, if you have a double distribution trend day, the second distribution of the double distribution trend day is usually a pretty reliable short-term trading vehicle. So if you look up here, we had the breakout was in I period to form the second distribution. We had the pullback in M period, did not close the second distribution. We're talking about reference points. Okay, when it didn't close and get back in that second distribution, that becomes a reference point. Okay, and at that point, that is very often a reliable place to buy a market. And I'm not saying there's other information that you need, but I'm just saying as we're going through this, as a generality, it trades like it would an independent day. I treat a double distribution trend day as two separate days, two separate ranges. If you have a double distribution trend day and you re-enter the lower distribution, that is usually fairly negative for at least the short-term market information. Okay, let's take a look, and then we have a balanced day. This is a balanced day. The fairest price to do business is about in the center of the range. It's equal on both sides. When a market is balanced, the message that a balanced market is delivering is the market saying it wants more information before it makes its next directional auction. Markets do speak to us. We have to learn how to listen to the market speak. Structure is one way to do that. The balanced day is telling us that the market wants to listen, wants more information before it makes its next directional move. What makes the market profile unique? It's a couple of things. It's the synthesis, or it's the combining of all of these separate elements to form a whole. We saw the original graphic, the famous graphic of Napoleon going into Russia. We saw how the size of the army diminished all the way along. We saw the change in temperature. We saw the change in food supplies. And it presented a pretty good whole as to the whole campaign. Look at one famous graphic. It presented a synthesis of the entire campaign. However, the other thing about the graphic, the profile graphic, you can take it apart. You can take it apart and look at the separate pieces. Markets are very complicated. We want to have the understanding of the whole, but at the same time, there is valuable information in the analysis of understanding the parts. Within the parts will be the nuances, right? The nuances will be within the parts. So we separate it down. It allows us to study the individual parts of the profile. For example, when we were talking about a market that we had a profile where the market went down, made a low, and then at one time framed up the rest of the day, had you not separated that into parts, you would not have been able to ascertain that the market one time framed up after it made the low. You wouldn't have seen that. By taking it apart, you see the pieces and you see what is happening after the low is made. And there's a logic to that, right? The auction process that we use in trading stocks and futures is what direction? Up or down? Or two-way? It's a two-way auction process. And in other words, it's continuous. It auctions from low to high, it auctions from high to low. In that two-way auction process is a continual search for information. Our job is to be able to extract the information that is contained within the two-way auction process. The best way we extract that information is by using the market profile to organize the data. One of the great mistakes, people get involved, they hear about market profile, and they get involved and they start going to the internet and they start looking for words on market profile. Okay? And you then have a whole series of people out there that use my first book, Mind Over Markets, as a basis for what they call their market profile site, or talking about the market profile. They make it mechanical. You buy here, you sell here. It doesn't work that way. What we're talking about in this video is about trading. We are talking about trading. We are simply using the market profile to organize the data generated by the two-way auction process in the market. The profile does not tell you to buy, it does not tell you to sell, it doesn't do any of that. It is very quiet. Okay? Now the database that forms it is dynamic because it changes throughout the day. But when you start hearing people tell you, well, you buy, the profiles like this, you buy down here, sell up here. It doesn't work that way. That's a very mechanical approach to it, and it's so much more than looking at a profile. We are talking about trading. And part of the reason that so many of my friends that are here today are here because they've been with us a long time. They've gone through the process and they well understand that the profile is a very minor part of it. We're talking about trading. We're talking about, we haven't gotten there yet, but understanding how momentum traders differ from value traders. And if you don't understand that, it's very hard to really successfully compete in the marketplace. They understand that trading is a game. People like to make it a science. It's not a science. It is an art, and there is an awful lot of gamesmanship that goes on. Other traders, hedge funds, people like this, they play games with the market. If you don't understand the potential for that game, it's going to be very difficult for you to participate in this thing. If you try and make it a science, it is going to be very frustrating to you. That's the biggest transition people have to make, is understanding that it's not always predictable. Sometimes the real advantage comes from the fact that it's not predictable. And the opportunities sometimes will come out of absolutely nowhere. And then you say, how do I prepare myself for that? If you understand the market structure, you will have a much better understanding of how to take advantage of that. For example, if the market structure is really strong, and let's say the market structure is to the upside, and everybody gets all panicked when the last Friday of the month, or first Friday of the month, what do we have announced? The jobs report, right? And you get all the TV, they hype you up, and the jobs report, you're all focused on the jobs report. Well, if the underlying structure of the market is strong, and the jobs report or the employment report comes out on that first Friday, and it's negative, guess what? You may get a knee-jerk reaction to the downside from traders that don't know anybody. They're just selling the headline because they don't want to think. You get an initial reaction to the downside, and then even though the number was negative, you finish the day to the upside. And you say, well, what happened? The number was negative. We throw a word around a lot we call cognitive dissonance. It's absolutely one of the things that kills traders. They hear the number is negative. They couldn't trade objectively to the long side of the market following that because cognitive dissonance is trying to hold two thoughts. The market structure may say the market's strong, but they've heard the commentator say the number's negative, as if the commentator really knew. They don't know the adjustments or expectations or anything else. But if you have an understanding that the market structure is strong, the number is negative, you get a little bounce down, structure supports it, and very often or not, the market will tear back to the opposite direction. The market is strong, and it gets a number that is consistent with that. You may get a market that just really accelerates to the upside. So again, so much is based upon structure. We had the break taking place not too long ago, and when that break was taking place, we were getting some awful good news. Okay, and why we're getting? Because the underlying structure wasn't very good. So anyhow, the value of the profile, we can look at the market in total, or holistically, or we can take it apart and perform analysis. We need to do both. Too much analysis, it will be very difficult to trade successfully. No analysis, it will also be very difficult to trade successfully. It is a combination of having a holistic understanding as well as an analytic understanding. Okay, let's kind of continue. Various structures, just a review. We looked at the primary day. We use it as a benchmark. We looked at a trend day. We looked at a balance, kind of a squat day. We looked at a short covering day. So these structures are all over the place. Within each structure, the market is talking to us differently, right? Just like years ago, it was on a very small basis, but when there used to be a lot of floor trading, the floor traders heard what was going on in the market. Now we do it through sight. Okay? We take a look, and this example, Billy Bob, you've been asking me about this example for some period of time. I used to run an institutional trading desk, and having run an institutional trading desk, you learned an awful lot about how big money trades. When big money comes into the market, they don't come into the market and buy all at once. If I get an order on an institutional trading desk, whether it's in futures or stocks, if I go and buy all of what I'm supposed to buy at one time, guess what? The chances I'm going to give a customer the best fill of the day are pretty slim. If I give them the best fill for the day, I got really lucky. I would prefer to give them an average fill. If I give them an average fill, I'm never going to give them the best, right? But I'm never going to give them the worst. And what you really don't want to do running an institutional desk, you never want to deliver the worst fill of the day to an institutional client. You will never be forgotten, and you probably won't have that business going forward. So let's say they give me a couple of million shares to buy if it's stock. What am I going to do? Or in this case, let's say sell. They're going to give me some to sell. I'll sell some early, so the market will break. I let the market settle. I sell some more. I let it settle. I sell some more. It's more like a wave-like process. And usually it's not just one institution. A lot of times you'll get a tone to a day, and that tone will continue throughout the day. This is the S&P's April 30th of this year. And as you can see, the high was made early. The high was made early. So there was aggressiveness from the opening bell, right? The market sold off, it balanced. It sold off again, it balanced. It sold off again. It was a wave-like action throughout the day. That's kind of a standard. Now, Sometimes you'll get markets just go straight down. I mean, they don't do any balancing. That's probably long liquidation. That's probably fear. These type of markets, when you have big money selling, will normally look something like this, normally like a wave kind of action. Again, another market that you don't want to go against. We've seen this fairly recently. Anyhow, just an example. Billy Bob, I know you've asked me for this. Now you've got it. We want to trade value, not price. We'll see the slide again. But think about any business. Price is an advertising mechanism. Time regulates all advertised opportunities. And volume measures the success or failure of all advertised opportunities. When you put time, price, and volume together, when you get the composite, you have value. Biggest insult I can say to someone is see somebody that's trading and say, oh, you trade price. I know. Well, how would you like to say, well, I trade an advertising mechanism? Sounds pretty silly, right? But that's all price is. Price advertises an opportunity. Some opportunities are accepted, right? Some opportunities are rejected. Value is kind of the composite of all of it. Before we took a break, we're talking about the value area, and we trade value, not price. I will promise you the most difficult thing that you will deal with if you get interested in what we're talking about is getting away from price. It is addictive. Our minds like price because it goes linear, right? It goes 1, 2, 3, 4, 5, 5, 4, 3, 2, 1. Boy, and we get so focused on it, we get hunched over the machine. The killer is getting trapped by price. It is addictive. It pulls you into it. I see Rue in the back. Rue is from Phoenix, as a tennis pro. Came out and traded with me one day, and one of the comments he made was, wow, he said, I can't believe it. He said, you sit back when you trade, and he said, you're taking in the full landscape. And it's that taking in the landscape that he coined that allows me to stay away from getting trapped by price. Sometimes I get tense. If I get tense, I tend to, kind of cuddle up the machine. You start to cuddle up the machine. You get overly focused on price, and you can't believe the mistakes you make because you lose the bigger perspective of what is going on. All right, let's take a look at some of the value area relationships. In here, all we're looking, we have lower value, higher value, overlapping to lower value, clearly higher value, clearly higher value. Notice the difference, value. You can have, we'll look later on, you can have situations where price is higher and value is lower, or price is lower and value is higher. When I knew that I was really making the transition to internalizing this information, and that's really what it's about, getting to the level where you've internalized the information. When somebody would ask me, what did the market do today? The standard, if I trade S&Ps, the standard answer might have been, oh, we were up 6.5 today. When I knew I had started to internalize the information, somebody would ask me that, and the first thing coming out of my head would be, value was higher today. And of course, you know, when you're talking to someone that has no idea what you're talking about, that is not an answer that gets a lot of appreciation, and they have no idea what you're talking about. But I knew that I was really starting to take this information to the next level. So we're always looking at value. We said earlier that one of the things that we're trying to do is visualize what the profile looks like before the day is over. We said the key is to visualize, not predict. But along with that, I'm always looking to see what kind of value am I going to have today. I'm going to have higher value, lower value, unchanged value, overlapping value. We were doing the live trading, as I mentioned, yesterday morning. And part of the process that we went through was looking and saying, okay, say price opened higher and it's starting to go lower, and you have a trade that looks like a good short. And you say, oh, wait a minute. Price is trying to go lower, but from where price is right now, what is the likelihood that we can even get unchanged value? And when all of a sudden we were saved on a couple of trades where we said, you know, we're an hour and a half into the day, there is no way that we're going to get unchanged value. We could get lower price, but we're not going to get unchanged value. And in those markets where we made those observations, before the day was over, the market turned around and went directionally with value, not in the same direction that price initially went. Let's take a couple of examples. We'll start over here on the left. Here's our value. Down here we have lower value, and we're looking at lower value and lower price. We come up here. The next we have higher value, higher price. The following day, we have overlapping to higher value, but we have lower price. So when you go through this, you have all of these combinations and permutations that can take place. They are very meaningful. As you gain experience, and you start to understand the difference between price and value, the question that you're always going to be dealing with, when price is away from value, the question is, will price get pulled back to value, or will value get pulled to price? That's the basic analytic question you're looking at. When you come in, for example, early on, we showed where the point of control did not migrate lower. If you remember, we had the 45-degree line, and we said people were getting caught short in the hole. I sent the email out that there may be a short covering trap. What was the issue I was dealing with? The issue was price going to get pulled back to value, or was value going to be pulled down to price? When we looked and we saw the fairest price to conduct business was not migrating lower, the chances were that price was going to snap back to where value was. Well, if you don't have any idea of the concept of price and value, you're never going to be able to make that analysis when you're trading the market. And if you don't think there's a difference between price and value, go out and next time you buy a car, whatever the sticker price says, if it's an American car, whatever the sticker price says, just write the check. Just write the check, right? How many people are going to do that? Because do you see price and value as being the same? You know, a lot of times you will pass something up because you look at the price, but you don't think the price offers value. Other times you will snap something up very quickly, right? Because you think, wow, that is a value situation. I made the comment earlier that I marvel at people that have been extremely successful in business, and I'm talking extremely successful in business. They will come in and they want to talk about learning to trade futures, but yet they will not employ the same principles that they employed in business in trading the market. They want to just look at price. I look at them and say, wait a minute, in business, no two prices were equal, right? And they're not. It's not in the market. But so many people have talked to them about price, and so many books they've read talk about price. They get sucked into price, and they lose the idea of the concept of the difference between price and value. You make money. You make money by buying something below value or selling it above value. You also make money in a trend. You also make money in a trend when you have a pretty good idea that you're ahead of the market and you have a pretty good idea that value is going to come up to meet your price. Those are the two decisions that you need to make. Historically, when you first start to read books on trading and start learning about trading, most people introduce you to reversion to the mean type of trades. Okay, they feel intuitively good, and in some markets they are wonderful. But that is when price is going to get pulled back to value. When you have a new trend taking place, price is leading value. And when price is leading value, those are the biggest opportunities. They are the most uncomfortable trades to make. If you have a breakout or you have a trend that begins where price is leading value, you're going to have to pay 12 for something that you could have paid 10 for yesterday. That intuitively doesn't feel good to us. However, very often when the trend develops, there is less risk. There is less risk in paying 12 for something than there is in paying 10 for it, because price is leading value. You're moving away from one distribution into another distribution. Amateur traders very often can't make that determination. Seasoned traders know that intuitively. But one of the things, what you really want to focus on in this area right now is thinking about the difference of price and value. In some cases, price will revert back to value. In other cases, price will lead value. If price is leading value, would you expect volume to be increasing or decreasing? Increasing, right? If I raise the price of a product I'm selling and my volume stays the same or increases, guess what? I got a trend going and it's very successful. And if I raise the price of something my volume increases or stays the same, before long, what am I gonna do again? I'm gonna raise the price again, right? Guess what we call that? We call it a trend. Okay, so these relationships are very, very important. You'll get price in the morning that opens within yesterday's range, outside of yesterday's range, within yesterday's value, outside of yesterday's value. Those are all extremely important relationships that you want to be aware of. When price opens right within the previous day's range, the previous day's value, what do you think the opportunity is? It's going to be a small opportunity, absolutely. When price opens outside of value and outside of the range, the opportunity is much greater. Even if it's an opportunity to continue in the way it opened, or an opportunity to snap back to where value was, it's still going to be a bigger opportunity. Okay, when we look at the far side, when we look at these relationships on the far side, we have price above value. At that point in time, price closes higher, however, value is actually lower. The opportunity now is really the question we addressed: will price get pulled back to value, or will value get pulled up to price? A lot of that is going to depend upon how prominent and how well designed the actual value area and the structure was. It takes a lot to get away from a well-defined value or structural area. Okay, so the question is, when price and value don't agree, we are looking at different variations of opportunities. The pitch session openings. What I'm going to do here, I'm going to talk about 4 types of openings. After we talk about these, we're then going to go to today's market and see if we see these relationships any place in today's market and how we would make use of them. The first type of opening is an open and drive. And an open and drive, price is basically on the low or the high of the day, depending on the direction of the auction. The market opens, price moves aggressively from the opening bell. The trading community or the investors knew what they wanted to do from the opening bell. It is very aggressive, it moves very quickly. It is the highest confidence opening you will see. The higher the confidence of the opening, the less the odds that you will come back through that opening price. And we're always talking about odds and confidence when we trade a market. We saw this yesterday. We had a market yesterday. It opened, it was back and forth through the opening multiple times. We said the confidence was very low. We said the confidence is very low. Guess what? I don't have to trade early, right? When the confidence is high, I need to trade quickly. A lot of times I get people ask me the question, well, Jim, I've heard people say I should trade later in the day after the market has set up. And I say, I know, I don't buy into any of that. You need to trade when the confidence is there, whether that happens early or late. in an open and drive, high confidence market, you tell me, do you want to trade early or want to trade late? You want to trade early. You want to get on the vehicle that's moving at that point in time. Just get on. Don't be a perfectionist. Don't nitpick it. Get on to the market, particularly if you're a short-term trader. Okay, so the first time we have an open and drive, usually the opening will be on or very close to the low for the day. The second highest confidence opening is an open test drive. So in this case, the market opens. It opens right here where the circle is. It opens, tests lower, and when it tests lower, it finds buyers. Very often in an open and test type of market situation, the test lower will go to some reference point that you could define. That reference point may be a pullback low, it may be a previous point of control, it may be a previous day's high or low, it may be a monthly or weekly high or low, but it will generally go to some reference point. So it tests, in other words, tests lower. Very often it will test to a reference point, and once you get to that reference point, you find there are buyers in the market. Once you find there are buyers in the market then continues in the opposite direction for most of the day. Second highest confidence opening you will have. Okay? Our third type is an open rejection reverse. In other words, in this case, the opening usually trades in the opposite direction from what the day will be for a more extended period of time. In other words, if the opening, in this case, if the opening and test was higher, when the market's going higher, what is it searching for? It's searching for sellers, absolutely. Okay, in an open rejection reverse, it just simply had to go a whole lot higher before it attracted the sellers. But once they got to that level, the sellers came in fairly aggressively and then took the market in the opposite direction. So when you're talking about confidence, open and drive, highest confidence. Open test drive, second highest confidence. Open rejection reversed, third level confidence. The level of confidence just tells you what are the chances that this market's going to come back at you before the day is over. And now let's look at the last type of opening, which is the lowest confidence opening. The lowest confidence opening is called an open auction. In other words, the market goes back and forth through the opening price multiple times. In other words, what do you think if it goes back and forth through the opening price multiple times? What do you think the level of conviction is? It's pretty low. Do you need to trade early or late? Trade late, absolutely. You trade late, relax, let the market come to you. Here's the difference. In an open auction, low confidence, sit back, let the market come to you. In a high confidence open, you have to go to the market, right? So you see the differences in there. Now, let's take this one step. Let's take this one step further. And let's look at today's markets. Let's start with the bonds. Okay? Now, on the right-hand side, you have first period in bonds. There's the opening right in the middle. Okay? What kind of an opening do you think I have in bonds today? Open auction, right? Back and forth through the auction, through the opening many times. So what do you think the opportunity is? Big or small right away? Small, right? Okay, let the market come to me, right? We've now traded for 1, 2, 3, 4, 5, 6, 7. We're in the 8th time period. And guess what? Has any confidence developed yet? No confidence at all, right? So I probably still haven't had a trade. Now, while we're looking at it, can you put the cursor on unchanged from yesterday? Right there. See that level right there? That's unchanged from yesterday. We're talking about nuances here. I didn't intend to talk about this, but it's up here. This is real. This is a live market today. One of the major references short-term traders will use is unchanged. When a market goes up and it can't get to unchanged, okay, can't get to unchanged, what's it going to do next more than likely? Look at A period. It got up, it got what, 1 tick short of unchanged? It couldn't make unchanged. Where did the auction go next? It went down and it looked right at this morning's opening. Went to the opening. How many people, most people don't understand that opening price, unchanged, they are tremendous short-term indicators to understand what's going on. Now we've got it went back up, couldn't make unchanged, coming back down. Nothing going on in the 30-year Treasury bonds, at least at this point. Okay? Nothing major. All right, let's take a look at, what's the next market we want to bring up? Okay, let's take a look at crude. Crude opened at where you see the ACD. Okay, pretty quiet early on. Then crude rallied to the upside. Okay, crude rallied. There's the opening. There's the A period. There's the B period. C period. So the opening was down early on. This is yesterday's range. Are we in or out of yesterday's range on crude? We're in yesterday's range, okay? So now let's add more complexity to it. So I take the opening and I put the opening inside of yesterday's range. See the blue line there? The blue line is value area from yesterday, where 70% of yesterday's trade took place. We opened outside of value, but we opened within yesterday's range. First period auction down, but in range, okay? In range, opportunity more than likely big or small? Probably small. We opened down and in the market in B period went down, tried to look at yesterday's low, right? Did it get it? Didn't get it. Okay, didn't get that. Now it's going to auction higher again. Okay, then it goes up and it gets to yesterday's. Guess what that level is? See that little up there, that BCD? We talked about that yesterday afternoon in the live trading seminar. We call that, it's an anomaly. Or that was another way, was the point of control. It was also the fairest price to do business. Okay? Most people would have no idea about that silly little price or that silly little anomaly. That was the fairest price at which business was being conducted yesterday. Look at the close. Yesterday was down here. The close was down there. Okay? What happened We talked early on, we introduced a subject called repair early on, right? We went back and revisited that part of the structure. That part of the structure, that anomaly, the market was having trouble moving away from that. Even though price came lower, it went back and revisited that part of yesterday's structure. Does it look like an anomaly? A rough edge? Does it stick out differently than anything else you see? Now, are you gonna, the first day you start to use this, are you gonna really pick up on that? Probably not. I said nuances are important. Most people, if they heard me talking about that, and I'm going to guess that yesterday, when we were in here yesterday, and I kept pointing out this price late in the day, I'm going to guess that even seasoned people that I've worked with for a long period of time were probably kind of shaking their head and saying, it's one price. It really, he's making a big deal out of something. Let's move on. Okay? And we trade down here. And it took a while, but look what it did today. That's a nuance. That is a nuance. Okay? We started talking about the openings. First we said open within yesterday's range, opportunity probably big or small. Probably small, right? Okay? And it was, right? We auctioned a little higher, a little lower. We went down, we didn't take the low, we auctioned a little higher. Then we went back up and checked out that price in D period. Then the market broke on the downside. Again, I had some information based upon where the market opened, and yes, the market opened from contextually, the market opened and drove lower. Let's look at the opening one more time this morning, please. Okay, the open's on the high. So we opened and we drove lower, right? So you say, oh, wait a minute, it's an open and drive. But the context is different. It's opened and drive and it's within yesterday's range. Opportunity is small. Then it doesn't get the low. If it doesn't get the low or the single, the buying tail from yesterday, first time, what's going to happen? This means sell. It gets down there and doesn't get it. If you were still on the floor, hands would be out. We'd start auctioning higher. Okay, so we looked at the bond opening, which was an open auction, back and forth, no confidence. 8 periods in, no op. Let's say I had a market and I have a 5-month high, okay? Do you think the short-term trader has any interest in taking the market out of a 5-month high? It's not what they do. However, the intermediate-term trader or the long-term trader might have an interest in that. So when I start to see a 4 or 5 month high and I go outside of that range, that gives me information that the participation in the market is by longer, more serious time frames. A long time frame ends, a long-term trend ends or terminates in an intermediate term trend. An intermediate term trader is a relatively substantial trader. They're what we may call swing traders. They may trade from the top to the bottom of a very wide trading range in there. You will also have short-term trends within the intermediate term trends. You have the long-term trend, you have intermediate term trends, you have short-term trends, and then daytime frame trades within the short-term trends. So it gets fairly complex in there. But you hear all the time, you know, you have the long-term trend is up, you get a correction, you know, to the long-term trend. So it may be a short-term trend that's correcting the long-term trend. Happens all the time. So the intermediate term trend may be people like John Henry, who's a major hedge fund up in Connecticut, maybe some of the Morningstar mutual funds, Barclays, alternative investment people, DB advisors from Deutsche Bank, people that are in the hedge fund or alternative investment world. These are, they're relatively big players. They tend to be fast players. They have quite a bit of money at stake. They employ quite a bit of leverage in the game, and they're meaningful. When they're in the market, they can move the market. But this group is not responsible for moving the market to new highs and new lows, right? That's not what they do. The long-term traders, which are our last group, will be people like Fidelity, JP Morgan, Vanguard, Invesco. These are just examples. These are just examples of the long-term traders or the sticky money traders. When they come in the market, they come in size. They come in size, and they really start to pressure a market either up or down. Their orders, the size of these orders are so big, they may exist for multiple days. They may be working a position for multiple days. I said I used to run an institutional trading desk. We may get orders that we're working for a substantial period of time. We're continually buying. We're buying every pullback, and we may be buying it for days. Okay? So part of your understanding of the markets is understanding when these kind of people, what time frame is in the market. And like I say, you will spend a lifetime wrestling with these issues and what time frame is in control. It is extremely important to you being a successful trader. We talk about the time it takes to assimilate the knowledge we're talking about. It is substantial. It is substantial. People that come in and think, I have people all the time who say, well, Jim, I'm smarter than the average. I want the 3-month course. Or don't you have a 6-month course? I just laugh and I say, it's been really very, very nice to meet you. But I'm not going to be able to help you. You're going to be frustrated with you. When you get into this, guess what? When we're talking about this, you're starting to feel a lot of ambiguity. Okay? Do people like ambiguity? They loathe it, right? They want an answer. Jim, what's the market going to do? I'm a reporter from CNBC. Well, which way, what do you think the last hour of trading is going to look like today? How high is it going? That's what people want to know, right? Watch one of those anchors when somebody says, I have no idea. They're just dying with their mic, right? Because that's not the way they answer. Years ago, they used to have used to be around the Merck and the S&P pit. One of the local radio stations came after me, and they wanted me to broadcast up there for them for 5 minutes in the morning and 5 minutes on the drive home after the markets closed. I said, guys, you're not going to want me. I said, if you hire me to do this, within a month you're going to be very apologetic. You're going to be singing and dancing and trying to get out of this. No, we've got a lot of I said, believe me. I said, the drive home will be okay. So anyhow, I went ahead and did it. And of course, it's a month later. Their readers are irate. They are irate. They want to know, where do I buy it? Where do I sell it? And I may tell them, I may be up there and say, this is an extremely low confidence day. I see no opportunities in here today in this S&P market. Boy, that goes over big, doesn't it? Now, the drive home people that listened were from the floor. They had a better understanding. So my ratings for the drive home was fine. Mid-morning, what do I buy? What do I sell? They couldn't get me out of there fast enough. And that's what happens with a lot of stuff. As we get into the more complex stuff, there is a tremendous amount of ambiguity. And it's that within that ambiguity are the real opportunities. Those that can get through it. Anyhow, time frame behavior, it reveals itself as the sessions unfold. Talking about who's in control of a market. If in fact a market goes exactly to last night's close, or exactly to the yesterday's high, or exactly to yesterday's low, or exactly halfway back in the morning, do you think that's the long time frame? Do you think that the longest time frame, do you even think they know what unchanged is and all? They don't know. Do you think it's the intermediate time frame? They could care less. They have no idea. A lot of these big firms, they don't even have bar charts in their shops. Now, when you start getting down, it goes exactly to unchanged, exactly to today's opening, exactly to the high and the low. Who do you think's dominating the market? What time frame? Probably the day time frame trader, right? Okay. The characteristics and the behavior of the day time frame trader is substantially different than the behavior of the next longest time frame. The day time frame trader will probably, if that's who's dominating the market, and what you're trying to do very early, figure out who's dominating the market. The day time frame trader, they will buy yesterday's high, they'll sell yesterday's low. The long time frame or longer time frame, they could care less. So you start very quickly to understand who's dominating the market today. Who's dominating the market starts to help you identify what your opportunities are. Figure out who's dominating the market. The day time frame trader, they will buy yesterday's high, they'll sell yesterday's low. The long time frame or longer time frame, they could care less. So you start very quickly to understand who's dominating the market today, who's dominating the market starts to help you identify what your opportunities are. Daytime frame control opens at the edge of the previous day's range, looks beyond the extreme but is contained. So there's the open. The market comes back to one tick above the open. That's all there is to it. This could have been bigger early on, right? What kind of an opening did I have? I had an open and drive. Okay, open and drive, I went one tick out of balance, open and drive, it could have been a big day, I don't know early on. When I see this, I want to immediately get what? I want to get long immediately, okay? I get long and I monitor the trade for what? Continuation. As the day goes on, I get back up to the point of control. Remember, it's hard to get away from it, but I start to get no elongation. Okay? When I can't get by this, do you see any evidence that there is any time frame other than the day time frame on the buy side of this market? Longer time frame, they'd go through that like a shot. They got back up to the really good traders know where the fairest price or the point of control was from yesterday. Where did most of the volume take place yesterday? At the point of control. Really good short-term traders, they know that. They automatically know that. And if they didn't write the price down, they just remembered. So we got up there, there wasn't anything there. So now the market comes down. We didn't take out the morning, we got to the morning opening exactly and rotated back up. Who do you think's in control of this day? It's all day time frame trading. Now, if you're sitting there trying to make a big trade out of this or trying to find the big trade, guess what? You're going to get whipped around. You're going to get the whipsaw. You're going to be very disappointed. It's just not there. So this idea of understanding the behavior of the different time frames and understanding what time frame is in control is extremely important. Okay, other than day time frame control, prices open in range but move quickly out. So when that starts to happen, you have an indication that if I open within yesterday's range and I start to move pretty quickly and pretty aggressively out of yesterday's range, is the day time frame in control? Probably not. At a minimum, it would be what time frame? Be the short time frame or the next longest time frame in there. It may be, and I don't want to confuse it, every time frame has some business to do every day. We are only talking about who is really dominating the market on a particular day. Okay, so you get in this. Also, you can look and see what the value, and you just start to get some aggression to the upside by a longer time frame. Look at the highs. Do you have a good high up there? And what do we define a good high as at least having some kind of selling tail. okay? When you don't have a good high, I call it a poor high or unsecure. Unsecure is it's probably not going to be lasting, or at least the odds of it being lasting aren't good. Remember, it's not quite that simple. It may be because the market's too long, but we have to learn to walk before we get, more advanced. But if I have that poor high up there, do I have any evidence that the next longer time frame came in to start to take advantage of higher prices and sell the market down? Weren't there, right? They may have been subtly selling something, but they weren't aggressively selling anything. Those are the clues. By organizing the data, that's revealed in the structure. If I had a single bar chart, a one-dimensional bar chart, think of all the information that I would not be privy to. I wouldn't see the depth, of the market, I wouldn't see the dynamics that are there. Okay, let's go on. Aha! The diffusion model. Years ago, when I did some lectures years ago, and I'd say to people, let me talk a little bit about the behavior of people. If I had a perfect idea, and I offered that perfect idea to 5 people in this room, and it was guaranteed that idea was could make $500 if you bought it today, would all 5 people buy it right now? More than likely not. I'd get one person that still buy it, and then it starts to move up a little bit, it's working. Then I get somebody else comes along and they buy it, right? And of course, the more evidence it's working, the more people that are willing to buy it. And finally, the 5th person in the room at the very top can't stand it anymore and they buy it, right? Does that go on in markets? Has it happened to us? Of course it has. So I used to use that for a long time. Then this guy, Malcolm Gladwell came along, and I forget which book this was in. Was this in the Tipping Point or Blink? Tipping Point. And what he did was he gave it a name and he put numbers behind it, which people love, right? They love a label, and 1, 2, 3, 4, 5, and give each one a label. Incidentally, Gladwell's got about 4 books out there. They are wonderful, wonderful reads. He is one of the best I've ever known that has the ability to go out and he really takes other people's research and he packages in a very, very wonderful way. It's the Tipping Point, it's Blink. The newest one is What the Dog Saw. But they're great for understanding the markets and people. The diffusion model he's talking about here, it's the same thing I talked about for years. You should put a label. The innovator is the first person in. Okay? So when I was a kid, that's all I really know when I was a kid was the Airstream. They were the innovators. Before we go here, and incidentally, innovators usually are not corporations and big organizations. Big organizations make decisions how? Through committees, right? Committees don't take big risks. I was one of them for a number of years. Innovators are normally individuals, pretty independent. Think about the name you hear a lot about the mortgage business. You hear about this guy Paulson, made $1 billion for himself, and I forget how many billion for, the clients of his hedge fund. It was his own hedge fund. He called the shots, right? He was the guy that was short the mortgage market, and some of these, one of these new great books written by the guy, Michael Lewis, that wrote The Blind Side, The Big Short. It's a great book. But, you know, he was the innovator. He got involved in shorting the mortgage market and made a lot of money. So the innovator is early to the party, usually fairly independent, usually very smart. Some risk, sometimes they're wrong. There's a firm no longer exists anymore, Bear Stearns. Bear Stearns for years never wanted to be the innovator. What they would do is they would wait till somebody else was in and had a good idea. Then they would come along, and they wanted to be what Gladwell would call the early adopter. After they saw there was some risk taken out of it, big manufacturing companies, drug companies, they go along and they buy people that are already underway. So you get the innovator, then you get the early adopter, and we walked through this and just kind of taking a look at the what's gone on in the recreational vehicle market. And one of the things, you've got the innovators, the early adopters, they enter the market, they identify that change is underway, and where did a lot of this take place? Let's go. Let's look at the next nothing. First, second, third, late majority. A lot of this real growth happened following 9/11. Okay, following 9/11, for people vacation, what were they feeling about airplane traffic? Traveling by plane. They weren't as comfortable, right? So people kind of changed how they did things. They changed their vacation. We got in and we got more mobile homes, more recreational vehicles, more manufacturers, more people entered the party. So we had the innovator, been around for a long time. You know, the Airstream. And we see this in the market all the time. Everybody knows what it's all about, right? And everybody's coming in, they're buying every break, and I just love this. I live in Prescott, Arizona, so I live out west. You actually have places that look like this out west, where you just look over the tops of these things. Matter of fact, we have the innovator. Okay, follow the innovator. We have, which would really be two, the early adopters. These are still intelligent people, but they let it get underway first. They get on the trend fairly early. Okay, so when they get on, the buying tail's already gone, right? The buying tail is the innovator. The early adopter is when you're starting to get the structure is forming a little bit. Then you go on and you get the early majority would be 3. The late majority would be 4. And we saw our late majority, everybody's in almost, right? We got almost everybody in. And then you finally get to the final stage, which is stage 5, where you get the laggards. And you see this all the time in markets, right? I mean, think about this behavior. All of a sudden, they know you cannot do anything but own the market. When you look at this, you see the years, you see the growth, and then you see what happens to the laggards. They're almost always late to the party. When you look at a market, let's say this market, say you got a market that's going up. When the high is finally made, you got the laggard, the final laggard short covers. So you got a market that's going up. The final stage, you get the laggard shorts that are covering, combined with the laggard longs that never got on board. So you got two laggards up there, met by, and who meets those people? The innovator. The innovators meet those people. So when the mortgage market was going down, when the mortgage market was at its peak to be shorted, okay, and you had these people flipping homes. My sister lives in Naples, Florida. One of the women down there, you know, had 50 homes she was owning, trying to flip. Can't understand why she went bankrupt. Okay, who came in? Paulson came in as the innovator, shorting the mortgage market. So it's understanding that is part of behavior, how we operate. We see it in the day time frame, we see it in the short time frame, we see it in the intermediate time frame, we see it in the long time frame. When the market broke in 2008, the market was off substantially. It was getting weaker. It was off substantially before the Lehman Brothers bankruptcy, because the thing was just coming apart. Then the volume for the last part of the market was huge, because guess what? The longest time frames were now liquidating the market. The longest time frames were the final laggards that took the market. And then after they were done, with huge volume, after they were done, the market moved back up from March of last year until just recently. So that process goes on for all time frames within the market. But I did a webinar for Linda Ratsky one time, and I was trying to convey the emotions that we go through as traders in the marketplace. And what I'm thinking about is the parimutuel betting. And let's assume that instead of closing the board, we leave the board open, and we leave the tote board open until just a couple of seconds before the final horse crosses the line. Okay, as you're watching the race, and it becomes clearer and clearer who the winner is going to be. If you can still bet, where is all the money going to be? It's going to the leader, right? And how much thought, you get so wrapped up in this auction process, how much thought do you think you're going to give to what the payoff is? There it goes. You can place your bet at any time, and of course they're coming into the far turn up by 6.5 lengths. They're widening the length. There's nobody coming from behind. You can still bet how much money is going into the betting pool. Okay? How do we determine the payout? By the amount of the what? The amount of the pool, right? What do you think the winnings are good? For every $2, you're going to get what? About $2 and a penny? Now, think about the risk. You're five lengths from the finish line. Horse stumbles. You could have made a penny, and you lose it all, right? But guess what? People get so caught up in the auction process. They get so caught up in this diffusion model and how they act and their behavior that they forget all about the risk they're taking and what the payoff's going to be. That is not made in jest. That happens in the markets every day. So I just want to throw that as an example. I want you to think about the diffusion model, and then of course when one day you wake up and you bought the high for the day or you sold the low for the day, and you say, oh my golly, I'm a laggard. You know, it's really probably not something you're going down to the local pub to brag about. But anybody that's traded for any period of time has been there. It's human, this human behavior plays out continually. There are two well-known names in the educational world. Amos Tversky has passed on. Daniel Kahneman is still teaching at Princeton. They won the Nobel Prize in economics for what they labeled, I'm forgetting the name of prospect theory, what they called prospect theory. Ask Kahneman one time, how'd you come up with that name? Oh, it means nothing, we're just trying to get people's attention. What the research showed was that markets are irrational. Surprise, surprise. However, the markets are irrational in a predictable manner. Think about the power of that. When we talk about the diffusion model and we talk about the pari-mutuel board and everything else, and we talk about, getting trapped where we buy the high or sell the low, was it rational? No, but it certainly was predictable, because that's the human behavior. That's what people do. The better you understand that, the better you can fend off getting trapped into the same process emotionally yourself. And this happens no matter how experienced the trader is. You will from time to time fall into these traps. One of the most important things you can do in order to prepare for any day is identify references. Some of these references will be daytime frame references. Some will be short time frame, and short time frame reference would be defined as what? 3 to 5 days. Intermediate term references and long term references. So you can categorize the references. All I want to do is kind of whet your appetite to them, and let's kind of look at a list of some of the reference that we're talking about. Some are fairly easy. The prior session, high or low. Okay? Another one that you may not be as familiar with is the overnight trading. Most of these markets trade overnight in the electronic market. The overnight high and low are significant reference points. I don't pay much attention to anything else overnight. I do pay attention to the overnight high and to the overnight low. There's some other things that are involved. I'm not going to go into those right now. I look at the close, or what is called unchanged. There's not a short-term trader in the world that doesn't know what unchanged is, which would be last night's close. POC, another word for POC is what? Fairest price to conduct business. The rally high or pullback low. Early this morning, we had a trend day going up. Late in the afternoon, one of our references was the pullback low. Okay, if the market was going in the opposite direction, the market was breaking, trend day breaking, and then you had a rally high, that rally high would also be a reference. One of the reasons we use references, because if change is going to take place, change is more than likely going to take place relative to a reference. Trading, incidentally, is about change. Without change, there's no opportunity. The question now, we're looking for how big is the change, or what could it be? So we've got the rally high or low, we've got bracket highs or lows, and incidentally, I'll confuse everybody tremendously because I use interchangeably trading range higher lows, bracket higher lows, they're all the same thing. I generally think of trading ranges as being smaller. So let's say you got a 10-day balance back and forth, and I tend to think of brackets as being, you know, several weeks or longer, but I interchange the two. But looking from the top of a balance area to the bottom of a balance area. So if you got a 10-day range from the top to the bottom would be the trading range or bracket high or low. Spikes, we haven't talked about spikes yet. We will talk about spikes. They happen late in the day, and we'll talk about those in a second. The current session opening price, where today's market opens, becomes a day time frame reference, and important particularly on those days when the market is controlled by the day time frame or short-term traders. Half back, so if a market has a range of say 1 to 10 in the morning, 5 would be half back, or someplace in between 5 and 6 would be half back. On a day when the market's being controlled by short time frame traders, you'll find that half back becomes a very important reference. And it sounds kind of crazy, but it's kind of the way the world works out there. Double distribution ranges. You saw a double distribution trend day early this morning, and I said the lower and the upper distribution traded as separate days, but also the bottom of each of those distributions, the top of each distributions, and the single prints that separate the two distributions. Those are all ranges. Then we have longer term references, and they come from the daily charts, from the weekly charts, and from the monthly charts. So there's a tremendous amount of work that you go through in order to identify references. The longer the reference, the more likely the change is going to be initiated by a longer time frame, and the more likely the change is going to be relatively significant. Can we go to CQG for just a minute? Sure. And look at gold? I'm told that I was looking at gold the other day, and one of the reasons I was looking at gold was because there's a lot of momentum trading going on in the market. Momentum traders trade a lot of gold, they trade a lot of crude oil, they trade a lot of stocks. They don't trade a lot of treasury bonds. So there's just certain kind of markets that the momentum traders like. One of the markets that they like a lot is gold. If you will hit comma M on there, go to bar chart, and if you look at bar chart, okay, now we're looking at the daily. We're looking at the monthly. We're looking at the monthly chart for gold. Okay, come across the old high. If I looked at that reference off of a monthly chart, would I call that a day time frame reference? No. Would I call it a short time frame reference? No. Would I call it an intermediate time frame reference? No. I would call it a long time frame reference. What time frame is responsible for breaking a market out into new territory? If you're at a market high, what time frame is responsible for breaking it into new ground? The long time frame, right? Okay. Now, what did we have go on today in gold? Gold is up, what, 2280? Gold's up 2280. We had a breakout, we had a long, that reference, and we were talking about gold the other day. We had that reference, so we had an upside breakout in the longest time frame with gold. That's how we would use that reference. Now, again, I talk about, we're not about mechanical trades, but there are some trades that you must do. When you have a market that comes out of one of those ranges or out of a balance area, you've got to put your orders in, you've got to go with those trades. If you're in fact going to be a trader and you're going to be successful over a long period of time. When you break out of a market like that, we're up 2280, okay? Now, think of the mentality, and I referred to this earlier. Some people would say, oh my golly, I can't buy gold here. The risk is too high. I'm not buying gold at new highs, okay? And I'm sitting there saying, there's actually less risk once it's broken out. On the side before you break out, the risk is heavy. Once you break out, the risk is light. Forget the price. Once it's broke out, it's into new ground. It's into new ground. You've got new players, new ball game. You need to go with that. You need to go with that trade. There's actually less risk buying the breakout today than there was buying it before we broke out. Before it breaks out, it may not make it, and the traders may come in and slam it down. Once it gets into new ground, guess what? Are they going to be bidding or offering? You go into new ground, they're bidding. And when you have a market that is well bid, you don't have any risk. As long as there's bidders in there, you don't have any risk. You go to the auction, you hear the auctioneer say, I have 93, I have 94, I have 95, 97 new bidder. Okay? When that process is going on, guess what? We're going higher, that auction's not over. Anyhow, let's go back to the references. We had been following gold, we've been working on references, and I wanted to show you one in real time that broke out today. One of the nice things about references, we talked earlier and we said there's a tremendous correlation between performance and preparation. And we see that in any kind of skill-based activity, whether it be sports, whether it be music, or anything else. So there is that kind of thing. You can prepare for the references before the market opens, right? You have the ability to do that in preparation for today's trading. If you aren't prepared and you're trying to do this once the market opens, the chances of being successful are very small. You're trying to focus on the market, you're trying to see we're in balance, out of balance. You're not prepared. This is something you can always do ahead of time. Okay, let's take a look. Day time frame references. We said earlier, that's what they look like. The overnight, high or low. The open. The open is always a day time frame reference. Every short-term trader knows where the market opened. And they're looking to see, are we going up or down from the open? we've already talked about the point of control. Okay? Now just one more thing on the point of control. Fairest price to do business. The more prominent, meaning reading from left to right, the more prominent the point of control is, the higher the odds that we will regress back to that price at some later date. For example, we saw this before, but look up here, the market opened, we went within 1 tick of the point of control, or the fairest price. It's hard to get away from it. Another reference that we talked earlier about half back, right? Another reference, there's another reference, the pullback low. A lot of these we've seen before. A close. Those are all day time frame references. Okay? So if you label them, and what I'm suggesting to now, and I just thought about this a few days ago, instead of we used to just put in references. Now I'm suggesting not only do you put in the reference, but if it's half back, just put in daytime frame reference to remind yourself it's a daytime frame reference. Okay? The shorter the time frame, the less significant the reference is going to be. If you're the shorter term trader, it's going to be very significant. If you're a long-term trader, you could care less about the daytime frame references. Then a lot of times they'd refer to those as noise. Okay, let's take a look and go a step further. More daytime frame trade, excess. A buying tail or a selling tail has another name for it. It's called excess. So when a market goes too high, let's say we see a market that runs up, it goes too high and sells off quickly, it was the end of the auction, we call that excess. Excess is one of the two most important concepts you will ever deal with in what we're talking about. Excess marks the end of one auction and the beginning of another auction. Is it daytime frame excess? Is it long time frame excess? We'll talk more about it, but excess is important in all time frames. We talked about double distribution ranges, single print ranges, excess on the bottom. So we just keep working through this idea of daytime frame references. Let's go on and see what more daytime frame references. The spike, okay? When we're talking here, this late break, and usually the spike is actually bigger than that. The definition of a spike is something that happens late in the day, either on the upside or the downside, relatively close to the close. And it is another way to think of a spike, it's a probe. A market either probing higher or probing lower. Okay, and we call it a spike, it happens late in the day, and a lot of times there's not enough time left to know if it was a valid probe. In other words, was it a price probe that was accepted, or was it a price probe that was rejected? If the probe is to the downside, for example, then the top of the spike would be what traditionally would be referred to as resistance. If it's to the upside, the bottom of the spike would be called support. Again, there's short-term references in there. What we're looking for the following morning to see if that price probe was accepted or rejected. If the market is auctioning higher and we have a late price probe to the upside, the market is looking for what? It's looking for sellers, right? So the question is, did the market go high enough to look for the sellers that it was attempting to find? So if we open below the spike the following morning, we have excess, and the market went high enough to find the sellers that it was searching for. If we open within the spike, the market did a pretty good job of finding acceptance. It went to the level where they found sellers. Some two-sided trade can take place. If we open above the spike, the market didn't go high enough to attract the sellers it was looking for late in the previous day. Also, we may start looking now at a 3-day balance. So here we have a 3-day trading range, and we're going to have the high and the low of that 3-day trading range. Becomes a reference. Okay, the high and the low of the 3-day trading range. Is it a day time frame reference or is it a short-term reference? It's a short-term reference, and remember, short-term time frame is 3 to 5 days, maybe a little longer. So start labeling it as a short-term reference. A short-term reference is going to have more significance than is a day time frame reference. So if you break out of a 3-day balance, okay, it's broken out not by the day time frame trade, it's broken out by at least the next longer time frame, which would be the short time frame. Just while we're here, the longer the balance has existed, the higher the odds that the move or the opportunity will be meaningful. Okay? Now, when you have balance, I should cover this, like I say, there's nothing simple about what we do. When you have a 3-day balance, you have 3 things that can happen. You come in on the 4th day, the market can remain in balance, right? When a market remains in balance and it trades from the top to the bottom of the balance, no matter 3 days, 5 days, etc., that is a short-term trader's paradise. They love that kind of trading. So, 1, it could stay within the balance. Secondly, it could look above the balance and fail, right? It attempts to go out of balance, it fails. If it attempts to go out of balance and fails, that usually sets up a pretty good opportunity in the opposite direction. Another term we'll introduce, what I call a destination trade. It looks above the balance and fails. The destination trade, or at least the target, becomes the opposite end of the balance. Okay, so 1, it stays within balance. 2, it looks above the balance and fails. 3, it breaks out of the balance and goes. So if you're coming in today and you got a 3-day balance, you're doing your homework tonight, you ought to be prepared for at least those 3 scenarios. So you're going to have the reference, you're going to have day time frame reference, and you're going to have the reference of the 3-day high and low. So if you come in, part of being prepared, you say, okay, what am I going to do if it stays within the balance? What am I going to do if it looks above it and fails? What am I going to do if it looks above it and goes? So at least you have prepared for 3 likely scenarios on the following day. You are going to be very much harder to compete against when you come in prepared with your references and prepared with scenarios that you might find of interest the following days. So if you're coming in today and you got a 3-day balance, you're doing your homework tonight, you ought to be prepared for at least those 3 scenarios. So you're going to have the reference, you're going to have day time frame reference, and you're going to have the reference of the 3-day high and low. So if you come in, part of being prepared, you say, okay, what am I going to do if it stays within the balance? What am I going to do if it looks above it and fails? What am I going to do if it looks above it and goes? So at least you have prepared for 3 likely scenarios on the following day. You are going to be very much harder to compete against when you come in prepared with your references and prepared with scenarios that you might find of interest the following days. Okay, let's take a look at the next reference. Another reference are anomalies. Remember, a little while ago, we had a market up here, and off to the right, we had one set of TPOs, meaning time price opportunities, reading from left to right, that was stuck out like a rough edge farther than anything else on the profile. And I said yesterday when I was talking about this, I'm sure several people in the audience are saying, okay, get on, okay, it's one price, it's one line. What was the high? We looked in the market today. The high was right up at exactly at that anomaly. So it's another reference, and it may not be tomorrow, but I keep them, and all it is, it's when the structure lacked symmetry. When you have a good structure, there'll be some kind of symmetry. When you start to see it lacks symmetry, you start to say, wait a minute, the trading wasn't smooth, maybe it was a little forced. Very often it will come back and smooth out that symmetry. Okay, let's take a look at some more references. Time frame. So intermediate time frame reference. So we look up here, if we're using a longer term chart, when you look up there, you say, okay, it doesn't take a genius to pull up a bar chart and say that's the highest the market's been in some period of time, right? You look up there, that's going to be an intermediate term reference. Then you may sit there and say, okay, over here, look within that, if I take this as the bottom of the trading range, the intermediate, and the top, I look in here, then I have a short-term trading range in the center of it. Okay, so I can have a short-term reference, which is 3 to 5 days, within the intermediate time frame. Right in here, I can have another short-term reference. Down here, at the low of that range, I have an intermediate term reference on the bottom. I have an intermediate term reference on the top. Then I can kind of calculate the center of the range, and you say, well, why would you do that? It's just something I do to help me keep perspective. Where am I trade location on an intermediate term trade relative to the top and the bottom of that intermediate term trading range or bracket? Then I can see on another short term, I got a 3-day balance in there. So I continually go through and mark my charts with reference points. I print them out, I keep them next to my computer. If I do this, a lot of times I'll do this on the weekend, so I don't have a lot to update during the week. Okay, let's take a look what else we've got in here. Longer term reference, okay, this is a monthly bar. Here's the intermediate term reference at $85 on crude. Okay, so that is a monthly basis. It's going to be what? A 9-month? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17, 19. I guess that's a 19-month high up there. That's a long-term reference. Okay? Have we taken out that reference? No. We took out that reference, I think, didn't we trade up to the $87 range? You know, in there. Now, so if I look above a reference and go, I look above a reference and fail, it keeps my perspective in the marketplace. We could go on a long time talking about these references. What I'm trying to do in this video is introduce you to the concepts that you then go back and you study on your own and start to decide if they make sense and do you understand them, and you make them relative to the time frame that you're interested in. a lot of times, a mistake that a lot of short-term traders make, and the reason I talk so much about short-term trading, our audience, there's more short-term traders than there are long-term traders. So our audience tends to be larger on the short time frame. The biggest mistake that short-term traders make is forgetting about where the longer time frame references are. When you get run over in a market, it is usually because you fail to recognize that the market reached a level that came to the attention of the short, intermediate, or very long time frame trader. And that's when all of a sudden you say, what in the world happened to this market today? It got to a level where other time frames were interested in buying, interested in selling, whatever it is, but they came off the sideline. They came off the sideline and became participants in the market, started to dominate the market, and you say, I have no idea what happened. Okay, let's take a look at more longer term references. This is the monthly bar for the crack spread. Okay, and we're up along the long-term reference high. The reference high here at the high is 1175. Okay, today a couple of traders in here trade the crack spread. There's the long-term reference. We had a big breakout on the crack spread today. What's the high on the crack spread today?
1538.
1538. Okay. 1175 when we did this chart a few days ago, but now we have this big breakout to the upside, 1538. That's a huge move. From I don't know where it actually broke from, but from 1175 to today's high, what's that? What's a one lot worth money-wise there? One lot on that spread.
$10 a tick.
$10 a tick. $10 a tick. That's a huge move. You see what happens? The importance of understanding these references, and when time frame changes, is really can make or break you. Okay, let's continue. The two most important concepts, I already talked about one. I talked about excess and balance. Excess happens in all time frames, whether it be 5-minute, 30-minute, daily, monthly, yearly. Okay? Excess marks the end of one auction and the beginning of another auction. Excess is the moment of greatest risk. It is also the moment of greatest reward if you are positioned correctly. If a market makes an excess high and falls away from it very quickly, like if you went to a good auction and the auctioneer really did a wonderful job, he takes it up and he squeezes the last bid out of that auction. And we said, the example we used earlier, say he got $150 for it, or 150,000, whatever it is, and he says, oh, by the way, I've got one more. If he did a really good auction, that second one shouldn't go for any more than about 125,000, right? If he completed the auction, it should fall away from there quickly. That's what excess does. This is all about the auction process, right? So when you get an excess high, whether it be daily, weekly, monthly, hourly, you walk up, you completed the auction, you fall away from it very quickly. If in fact you get short with that, you're in a great position. If you stay long, it's the greatest risk you're going to take because you've just had a change in auctions and you're positioned in the wrong way. Now, when you look at that on paper, it sounds pretty simple. However, keep in mind, when the auction goes up, let's say the excess happens on the high, the excess is going to occur in the face of the most recent market activity. So what your eyes just saw was a market making a new high. It falls away from it, and I'm telling you, well, your position should be short now. How hard is that trade to do? You know better. You just saw the market going up, right? So you have to work with this concept for a period of time to appreciate the power of it. But if you relate it to the auction process and say, wait a minute, once the auction is over, it ought to drop away from it very quickly. Okay? The second concept that is so powerful, and again, these are two concepts you can walk out of here and use tomorrow. A lot of the things we talk about, there's more ambiguity, there's more context. You have to take them and you have to make them part of your daily trading and part of your life for a long period of time before they become internalized. But balance. When you come out of balance, the market is starting a new auction. So it is the start of a new auction. Again, it is the moment of greatest risk and the moment of greatest opportunity. We talked about the crack spread breaking to the upside. Okay? It was almost $4 above what the, is it $4 or 40 cents above what we were at just a few days ago. Okay? If you sit down and we looked at gold, gold was up $22.80 today. We saw it break above a new high, right? You came out of balance. You started a new auction. Moment of greatest risk, moment of greatest opportunity. A lot of times it is easy to talk about. It is very hard to execute because it flies in the face of what you have been seeing. And we tend to, unless we have worked on our imagination, unless we've worked on these concepts, it is really hard to go against something you've just seen. Or if it breaks to the upside and it's a new breakout, you're being asked to pay 12 for something you could have paid 10 for yesterday. So I'm not doing that. I'm no fool. And those are the really big trades. Those are the big opportunities. So that's excess and balance. Two very, very important concepts. Okay? Balance. Approximately, and I ask you to do this on your own, I don't care if it's monthly, weekly, or anything else, about 85% of the days will have some meaningful overlap with each other. How many people in here trade options? Okay, a few people trade options. Part of the problem with trading options is the loss of time premium. You know, and a lot of that happens because of the overlap, the days that overlap, and the time premium starts to disappear. And if you walk through here, and I don't care if you're using daily, weekly, monthly, but you'll see there's a tremendous amount of overlap. As long as you know that and understand it, it will start to help you adjust and build your strategies as well as your tactics. Okay? Short-term balance. Again, I threw this term out before, and I love it. Short-term balance is absolute paradise for short-term traders, because what are you doing? You're trying to trade the top to the bottom of the balance. So it's paradise there. However, what happens to traders? How many times you hear me say, traders do what works until what? Until it doesn't work anymore. So now, let's say a market's been in a 4-day balance, and you've been pretty good at identifying the top and the bottom of that balance for the past 4 days. Now, on day 5, you break out from the top of the 5-day balance. Most traders are going to do what? They're going to fade the breakout, because all of a sudden they're going to see it. They're going to see it, oh, another chance to fade or sell at the top of the balance. So they sell it, and they're absolutely as wrong can be, because the market has broken out to the upside. As long as you understand that's the process, you can operate very successfully within that framework. Now, here's something that I disagree with almost everybody that teaches about how to work and trade with markets. People will tell you, and it always sounds so good, that, they put their arm around you and they're really being your friend. Let me tell you what you do. You figure out what it is you do best, and then you concentrate on what it is that you are the best at. I don't believe that. I think if you're going to be a professional trader, you have got to learn to be able to adjust to what the market is doing. You want to make a living out of this? If it's a hobby, that's fine. Go do what you think. If you're talking about being a professional trader, you have to be able to trade every kind of market. If you've got a market that's in a trading range, you become a you trade the trading range. Trading ranges are going to be mostly regression to the mean type of trades. Okay? Market breaks out of the trading range, then you've got to be a more aggressive trend type of trader and go with the breakout. You have to be able to trade what is going on in the market. So many times we get this thing down. Well, I'm going to do this. I'm going to do short-term trades, and it works for a while, and all of a sudden it just takes you out of the game, and you don't understand. People say, well, I'm really there. I'm almost there, Jim. If I hadn't been for that one day. Well, that one day was probably the day that you broke out of a range, and it takes back multiple days. Not only do you lose financial capital, but more importantly, when that happens, you lose something even more valuable, and that's emotional capital. When you lose emotional capital, you lose confidence. When you lose confidence, it is very difficult to trade and trade smartly. You get behind emotionally, you start thinking worst case scenarios, you start engaging in some behavior that is self-destructive. We're in a period right now, for those that are, when you look at this video down the road, you probably won't recall it, but we're in a situation right now where there's talk about some economic problems in Greece. That has spread over to Portugal, that has spread over to Spain, and now they're talking about contagion, and now this may affect the entire world. With that, the dollar has become the vehicle of choice. Right up here, we're looking at the dollar index, which I think is comprised of 6 different currencies, but it makes up that trading. That's what we use to kind of measure it on a market. But the volatility is extreme. It is not regression to the mean type of trading. Trying to keep it on, you got excess, you've got gaps, it's all over the lot. If that's too volatile for you, stop. But you cannot do dinky little regression to the mean trade in this type of environment. It's also what I call background. You ought to make a note of what is actually going on in the market. Is the market trading on its own, or is it being driven by other outside factors? Many traders can't expand their imagination to move beyond the intuitive and misleading concept that there is more risk to paying 12 than there is paying 10 for something. trading is, a lot of trading is about creative problem solving. Very important to be a creative problem solver. Be a creative problem solver, you need to develop an imagination. To enjoy imagination, you have to let your mind open up and kind of wonder. When you look today, if you start to study balance and you start your mind to expand, you say, wait a minute, if I broke into a new high in gold or in the crack spread, I could move gold, I could move $22. Well, if your imagination only lets you see $3 or $4, guess what? You don't have a chance. There's an awful lot of imagination involved. New discovery, new trends, new things. They're covered and they're found out by imagination. My biggest mistakes I ever make is I get so focused on a market because it's lulled me to sleep. It's been in a, kind of a tight trading range for some period of time. You just can't imagine that this market could break out and just go like crazy. And it happens all the time. So it's a question of imagination. You got a 2-day balance. We come out of the 2-day balance. You want to be able to go with those trades, monitor for continuation. Sometimes you'll be surprised how big the move can be. Okay, let's take a look at some more. This is the daily balance, mini S&P. I just wanted to kind of walk through some examples in here. What do I have down there? I have 1, 2, 3, 4, 5, 6. If I counted right, 7, 8. Looks like a 9-day balance. Then it breaks out of that balance, right? So the market comes up to here. We broke out of this balance right here. We broke out of this balance. There's the breakout day. We came up and balanced again. Notice this balance and this balance. We balanced again, and the market is moving higher. Understanding coming out of balance is really the trend. You've got a trend underway. So it's this is in the February and March period. What is this right here? Excess, right? That's excess. Excess marks what? The end of what? One auction, the beginning of a new auction. Where was this market going before we put the excess in? It's going down, right? Right there, it goes down, it puts in the low. We mark the end of one auction, the beginning of another auction. If I remember, this auction was only a mere 600 points or so. Okay, once it got underway. The two most important concepts you'll ever deal with are excess, and balance. End of one auction, start of a new auction. Balance, start of a new auction. Okay, let's continue to walk through this. Monthly balance. We get the same thing in monthly balances. So here we are right here. The market has been balancing on a monthly basis. There's an intermediate term excess high. Remember, this is a monthly. Intermediate term excess high. From that high, the market trades all the way back down, right? Trades all the way back down, almost to the other end of the extreme. And this would be called what? If we looked up here and failed on this intermediate auction, and we auction all the way down here, what would that be called on the bottom of that trading range? Destination trade. It's a reference point, but remember, once we look above something, then I start thinking, and the term I use is destination trade. I then start thinking the destination trade. If I fail at this end of balance, the destination trade is down here to the opposite end of balance. If I took out yesterday's high in a daily thing and the market fails, I would start thinking the possibility that I could trade down to yesterday's low. That would be my destination trade. Does it mean it has to trade there? No, but at least it gives me a reference to see how that auction is progressing. So now we come up, remember this is long term, we break above, we come in here, we break above, we take out this excess, and the market's off and running. And then you develop more long-term excess, and you start to work your way back down. This is the monthly bar. So this is actually not good. It looks like it's not very long time, but remember, it's in a monthly basis. Right down here, the market was right down here and it was pressing. These are the bonds. It was pressing to go back. We were trading over here. People were talking about taking out the low, going back to 2007. We're down on the bottom. You had the people coming on TV talking about bonds were really bad. The foreigners were going to stop buying our bonds. China, Japan, they had the whole world scared to death that we're going lower on the bonds. In the paper the other day, there was an article about they were blaming Nassim Taleb, the author, one of my favorite authors who wrote The Black Swan and Fooled by Randomness. Great writer that you ought to read multiple times. They were blaming him for the market. He put in a $7.5 million order to buy 50,000 option contracts. So that was one of the culprits. But Taleb writes about randomness in the market. Fooled by randomness, the black swan, and exogenous events causing these things. And I always was amazed because down at the bottom, for a guy that believes in randomness, he was on TV talking about how bad the bonds, what was going to happen to the bonds. And guess what? That may be right for a long-term basis, but that's not where the bonds went. That's probably about an $8,000 move. I forget exactly what the low was. If you take that reference point, when this market on a long-term basis, as much as they pressed on this, they didn't get it. Okay? First of all, how did you get down here, down this low in the first place? People were doing what? Selling the market, right? And we used the term earlier, short in the hole. Short in the hole means short at very bad prices. Now, generally, we think of being short in the hole as happening to daytime frame traders. But you saw we have scalpers, we have daytime frame, short time, intermediate, long term. Guess what? It happens to all time frames. When we got down here, I think it's pretty clear that we had the whole, we had the whole world short. And when you get down here and you can't go any further, sometimes the market has to rally before what? Before it breaks. One thing, it's easier to understand in the day time frame, but if this is longer time frame, watch out. Incidentally, those that get some of my written comments, what did I write the other day? picked up an article, and it's a publication that goes out to some hedge funds, that the 10-year bond was at historic low rates. I'm sorry, the 10-year bond was historic short interest. The shortest the 10-year bond had ever been recorded. Right smack on the bottom of the market. Guess what? That's not daytime frame traders, right? Your long time frame traders were short at very bad prices in the marketplace. Now, at the same time, you really want to understand markets, and somebody help me if I get the numbers wrong, but there was another article not too long ago, and Goldman Sachs was looking for 3.25 on the 10-year, 3.25 yield on the 10-year, and Morgan Stanley was looking for what, 5? 5.5. 3.25, 5.5 yield. Two big trading firms, Goldman Sachs, Morgan Stanley, 3.25, 5.5. That is absolutely a huge difference. Two of the biggest players in the world having totally different opinions on where the bond market is going. And I say that, and the importance is the reason that you want to get involved in what I'm talking about is you don't want to pick sides. You don't want to have to pick sides with Goldman or Morgan Stanley. You want to be able to read the market on your own, look at the market-generated information, understand the auction process, and trade the market accordingly. We got down here and we didn't take out this low. We got the whole world short. And where's the market? It's off and running. It's hard for anybody to imagine the market could go that high. Now people say, well, Jim, yeah, but that was only because of the flight to safety, because of what was going on in Greece, Portugal, Spain, and contagion. I say, yes, that may have attributed to it, but guess what? If the market conditions weren't set up properly, it wouldn't have got there. In other words, if the market wasn't too short, you probably never would have gotten there. But once the market gets caught short, one short cover begets another short cover, and then you have price-based systems, and you got these traders have price-based systems and hedge funds, and they start buying based on their price-based system. Hey, we're off and running. Does it make sense? Maybe not. Does it happen? Absolutely. There will be huge disconnects continually between what the economic reality is and what the market reality is. The only reality, if you're going to be a trader, that means anything to you is the market reality. If you want to be an economist, get into another business. We bury economists in the trading world. This is trading. Remember, I also said trading's a game. When the traders know that they've got the long time frame caught short, guess what the hedge funds are going to do? They're going to squeeze them, right? You hear people talk about, and somebody was sitting up in the front row the other day, said, well, Jim, aren't there market makers that take the other side of the trade? And half the people have been around were trying to keep a straight face in the room. Because these market makers, theoretically, if the market's going bid, they're not taking the other side. They're doing what? They're joining the bid. They're going to squeeze it. They're going to squeeze it just as hard as they can possibly squeeze it. So you get these tremendous moves in the market. They have nothing to do with reality. nothing to do with the fundamentals a lot, but it has to do with market-generated information. An auction is going to go till it's over, right? You go to an auction, it doesn't make any difference how much work you've done and how much you think something's worth at the auction. If somebody's willing to pay more for it, guess what? That auction's going higher. Okay, let's go on. We have a weekly balance in bonds. So when I look at my charts, I look at the monthly balance, I look at the weekly balance, I mark the references for the highs and lows so I know where those levels are. Let's take a look at the next slide. Okay. Now we have a spike. So we have an excess spike in here, another form of reference. When I get the spike, what did I call it? If the spike is to the downside, and we see that's pretty high, we got the spike, but it stayed pretty wide up there. So the market was already showing us some indication that it didn't want to go much lower. But we're looking at those things. We're counting that as a reference. 1040.75 was the low for the year. So even though we got the spike down there, we got to the low for the year. That reference worked, and the market started to move off of that reference. The break the last week, if you look on a bar chart, you will see that when the market went down 1,000 points, it went down to the excess low from February. And we talked about that earlier. We got the excess low, then it rallied. The first rally out, it was 600 points. Before it was all done, it was substantially larger than that. But the market went down to a very identifiable break last week when it was down 1,000. Now the question is, were you fast enough? I didn't have an imagination that told me we could go down to that reference. I pride myself on imagination. That wasn't one of them that worked very well. Okay, let's continue to move on. Long-term balance and excess. In here, we've looked at this before, or something similar. Our excess low, the market's been going this way. Excess marks the end of one auction, the beginning of the next auction. Then the market starts to rally higher. One of the things that we do to judge the age of a trend, most people get trapped by judging the age of a trend by their intuitive feeling that price is too high or too low or whatever. Okay? There's the excess. Excess starts a new auction, right? Excess goes up, and what do I have right here? I have a balance. So it balanced for 1, 2, 3, 4, 5, 6, 7, 8 days. Then what do I have here? It does. It breaks out of this, and I balance again. Okay? The balance, there's a balance. Right down there, we'll call this the first balance. No, this is actually a balance right in here. Once it re-entered this, the destination trade becomes up here someplace. Then I got a balance again. When we have balances, doesn't work perfectly, but the distance between one balance to another balance is an indication of the age of the trend. If you take the high of one balance and the low of the next balance, and you can put your pencil or a finger between it, the auction is relatively low. When the next balance area sits on top of or back within the previous balance area, doesn't mean the auction's over, it means it's aging. We break out of here, we do get a little 3-day balance, but coming out of here, the next balance is considerably higher. So what this from here, from the excess up to here, it's telling me that the auction is still relatively what? Still relatively young. Now, that may contrast tremendously with what your intuitive feelings are telling you. It may contrast with what you hear on the news, but if you sit there and do your own work, even looking right here, coming down, the balance between here and here, the market's got a lot longer to, it's a pretty good move. That's 1140, finally moves down here to about, what is that, 1040? About another 100 handles. Balance, break below it, balance. You can drive 2 Jeeps, a car, and a truck through here, right? Balance, it's still fairly young. We've distanced, this isn't quite as much, but notice we never really balanced. We got the excess, and now we're back up into here. So that if you took the next balance right here, you see how it's kind of back into that balance? You get the feeling that you've got excess on the bottom. You didn't, your next balance, if I took it right through here, your next balance is back really into this. So you're getting aged, you're getting older. Now you're really starting to accelerate up there. It's a younger auction. Again, much more reliable than thinking what you feel intuitive or what you read or anything else. Non-linear breaks. You'll hear me talk a lot about coming out of balance. You get a non-linear break. These are good profit potentials. They are also killers if you are the wrong way in a market. A non-linear break is nothing more than a very rapid reordering of the thinking in a marketplace. People resist change forever. How many know the name Kuhn? K-U-H. Kuhn was a scientist born in, I think, 1922. And one of the words that he made famous was paradigm shift. Paradigm shift just simply means a reorder of thinking. But when Kuhn goes through his whole explanation, people fight change drastically. They don't like change. So they put it off until there's so many anomalies that they can no longer deny that change is occurring. When they get to that realization, that is when you get a non-linear break in the market, or you get a whole reorder of thinking. Now, when Kuhn was talking about, paradigm shifts and all this, he was talking something much bigger than we're talking. But I find the same type of thing occurs in all time frames. Whether it's day time frame, they're dying like this, and everybody's got their narrow little view, and all of a sudden enough anomalies take place, and they realize they're wrong, and you get this huge rapid move out of one distribution to another. The same thing happens with the longer the time frame you go, it happens with all the way along. And I think this is not what Kuhn intended, but I think it's very similar. And these nonlinear breaks are, so we get a nonlinear break, we get a paradigm shift. Now we go to a new model, a new way of thinking, a new status quo, and now we go back and we go into range-bound trading for a period of time. Paradise for shorter-term trading. I think this process happens continually. Even here on this multi-day balance right here, what did we get right here? We look below, now there's a case. We looked below the balance. Did we fail or were we successful? We failed, looked below the balance, it failed, the bidders were there, the market was bad, and then once you re-enter this, the destination trade becomes what? The other end, the destination trade comes up here. Anyhow, there's all kind of information in here. It's a lot harder when you're in front of a machine and price and moving than it is when you're sitting with somebody who's got pre-prepared slides. Okay, let's go on and see what we've got up. Gaps. Gaps are also a form of excess. Gaps are also a form of nonlinear movement. Gaps also perform very similar to Kuhn's philosophy of a paradigm shift, a reorder of thinking. When a market gaps higher or lower, at least from last night to this morning, there's a total reorder of thinking about what is the correct price or value. Gaps are extremely important. Now, for those that have done a lot of work in traditional market and thinking, you will think of a gap as the difference between last night's close or settle and today's opening. That is not the gap I'm talking about. I pay no attention to that. The gap I'm talking about is outside of yesterday's, totally outside of yesterday's range. Has nothing to do with last night's settle. It's outside of yesterday's range. So a gap has to go, if it's a gap to the downside, it has to go below and stay below yesterday's range. That is a gap to the downside, the way I look at it. Am I out of balance? I'm out of balance. I'm out of balance to a pretty good degree. Okay? Let's take a look at what we've got coming up next. Excess occurs in all time frames. You've heard this before. Marks the end of one auction, beginning of another auction. Is it applicable to the day time frame? It is. I use 30-minute increments to construct my profiles. I don't care if you use 15 minutes, 1 hour. The principles are the same in all time frames. The principles ought to be exactly the same in all markets that are financial in nature. Now, I used to do this for real estate. I sold a home. I lived north of Chicago. I sold a home. I did the same thing. Now, they may have to advertise a little longer in real estate, but the principles ought to be the same, whether it's a bank allocating credit, real estate, financial markets. The only change will be things in the stock and futures market happen far more rapidly. But the basic three principles are time, price, and volume. Price does what? Advertises what? Opportunity. What regulates all advertised opportunity? It's time, right? And volume measures the success or failure of all advertised opportunities. Three basic economic principles applicable to all markets that are financial in nature. Okay, what do? That's part of the auction process. We use the market profile to record the auction process and the dynamics of what is going on. What is different in our market is we continue to auction from high to low and low to high, because it's a continuous two-way auction process. Excess starts the trade location process all over. We haven't talked about it today, but let's go back and think about a 10-day, we looked at some charts that had like a 10-day balance. Let me talk about trade location for a second. If I am at the bottom or top extreme of a 10-day balance, does it take me very long to know if I'm right or wrong? If I buy at the bottom and I get outside, I know pretty quickly I'm wrong. I sell at the top, I know pretty quickly if I'm right or wrong. If I get emotionally involved and I buy right in the middle of a 10-day balance, how far does that market have to auction before I get confirmation that I'm right or wrong? It's got to go to one extreme or the other, right? So now, let's talk about risk. Risk is a word that everybody throws around, but I don't think many people understand risk. Risk is a point, to me, risk is the point that where I know I'm wrong in a trade. So if I look at a 10-day balance, one of the things I do, and I say, okay, the bottom of that range is my lowest trade location. I go up a quarter, I go up a half, 3/4 a top. I can calibrate from a trade location standpoint where I am entering into or exiting my trade. Trade location is one of the best risk qualifiers you'll ever run across. Remember, if I buy or sell in the middle of a 10-day balance, I gotta move an awful long way before I really know if I'm right or wrong. If I concentrate on trade location, I can reduce my risk, I can know much quicker if I'm right or wrong, and also if I'm right, I've got a much bigger opportunity. Trade location is one of the best risk qualifiers you will ever run across. And when you get excess, okay, excess marks the end of what? One auction and the beginning of a new auction, right? So excess also starts the trade location process all over again. So if I buy right on the excess or a couple ticks above it, doesn't take me long to know I'm wrong. The higher I get away from it, the greater the risk that I have, or theoretically. So I'm only using that in one aspect. I'm using it to identify trade location. I'm using trade location as one element to identify what is my risk, how much risk am I employing. Okay, again we say here, it's very difficult to execute unless you have prepared. If you've got a market coming down, and it's coming down on lower volume, poor structure, and I'm finally getting excess. If I see the market coming down, lower volume, poor structure, while I do my homework and preparation at night, I may start to prepare and looking for a buying opportunity. I'm saying, okay, I don't think it's completed yet. I don't think the auction process is completed. But I'm prepared and I'm looking for an opportunity. Now I get an excess low. I'm already prepared. I've already mentally conditioned myself. Now my ability to execute on that trade is far greater. Then all of a sudden I'm the guy that came off the floor, I hung my coat up, I went and had a beer, I came in the next morning, put my trade on, the market starts to trade, and I said, oh, what am I going to do today? There is no preparation. When you get to that great opportunity, you probably won't recognize it, you won't be prepared to take advantage of it. So as you do your preparation, your scenarios, you may say the last couple of days have been really poor, coming down, volume, structure, everything else. You say it doesn't look completed. But if I get any kind of excess low or good trade location, I may look for a place to go long. I've done some preparation. I have some idea what I want to do. I have some kind of strategic thinking. I have some idea of how tactically I may want to get into that trade. I am prepared. I will compete against you when I'm prepared. When I'm not prepared, it's going to be much harder, because when price is moving around, it's really hard to think on the fly. It's really hard. And the more emotion you're under, the more unprepared you are, the more you start thinking worst case scenario. The more you start thinking worst case scenario, the narrower your thought process gets, the greater the opportunity that you're going to do exactly what you shouldn't do. Okay? Let's continue and look here. Now, trade location is the best tool available for risk control. Same thing we've just talked about. Review. Excess starts the trade location process all over again. You can just kind of see from here back up to the top. Look it up here. Right there, there's a little balance. What's this trade location up here? Almost at the top, right? Then we got trade location, and right here is a little excess. And what do we have right here? A little bit of balance, right? Bang, we come out of balance. What do you think your imagination can handle this? Unless you're prepared. But if I sit there and say the trade location is here, the trade location here, balance is here, and you don't know it's going to be this big, but what you do want to do is be prepared coming out of balance. You want to be prepared to go with that trade. It is going to be much harder to do because the breakout is going to be down in here someplace. So the market's already going to be down for the day. And if you don't understand it's a breakout from balance, it's going to be really hard for you to go with that trade. If you understand trade location from the top, you understand the balance, you come out of balance, you understand the destination trade is someplace down the lower end. If you understand that, all of a sudden, your world starts to move in slow motion. You start to see the trade developing. You know, it's like a pass. I'm in Chicago, so it's like Michael Jordan passing behind his back, looking off to the right, and you say, how did number 23 ever do that? Okay? Prepared. It's worked for a long period of time. The name of this video we're doing is called Field of Vision. Field of vision, you get up there, you're looking at a lot of things. Your field of vision, it's taking in the high, it's taking in the low, it's taking in the balance, it's taking in the excess. Let me share with you for a second how we came up with that name. I'm talking with Julia one day, and Julia was a star field hockey player at UMass. And we were just talking about trading and the emotions and all the pieces that are involved. And I said, tell me about the really good players at UMass. And she said, well, the best player we had was Megan. Megan went to the Olympics twice?
3 times.
3 times. Megan went to the Olympics 3 times. She works for State Street Bank and Trust today. And Julia said it was hard to believe how calm she was. How calm she was and saw everything that was going on in the field. And she said she never made an angle shot at the goal. Well, I mean, I wouldn't have known that, but I thought, well, an angle shot, guess what? I said I could see you got more time to see it, you got more time to cut it off. She said her shot, when she made her shot, it was always straight, hard, and right at the goal. A kind of a direct shot. And then out of her mouth came, she had a great field of vision. And I just said, thank you very much. I think we have the name of our trading video, because it just made sense that that is what we're talking about. And then I quizzed Julia more about some of the other players. Yeah, she said there were other players that were more emotional. Their shots were more erratic, more anxious to take the shots, not as much field of vision, not as much patience. But she said, you looked at Megan, you really never knew that she had the whole field of vision in mind. And it's just one of those things, when that came out of her mouth, I just knew that was what it is. And as we thought about it for the next 2 or 3 days, we said that's got to be what it is. But that's what it's about. And isn't this, you're taking in to do these really good trades, and that's a great opportunity. You have to have the field of vision in mind. You can't you start making a few erratic shots, or one of the other things that goes on, you get this great opportunities coming up, and you're making some little insignificant trade. You get into some little insignificant trade, it's the wrong direction. And what's the problem with a bad trade? Problem with a bad trade, it keeps you out of a good trade. And we've all been there. We sit in front of our machines, we think we're paying for the quote equipment and everything else. We end up doing some trade that was meaningless, and we miss the really big opportunities. We close down, we miss the field of vision in there. Now what happens, we go all the way down to the lower. We looked at part of this before. We go all the way down to this extreme. Then what happens? We fail, we don't carry through. Okay, where's the next auction going? We saw it on a day time frame basis. It happens in all time frames. So then what did the market do? It started going back the other way. Okay, so it's all within the field. Destination trade, I threw it out. This is the first time I've seen, I think you've seen it in print. If you failed at yesterday's high, the thought you would be thinking about would be trading back down to yesterday's low as a potential destination trade. You look at the top of a balance area high and you fail, you start thinking that it failed right there. You start thinking the destination trade down to the other end. Down on this side, look at the gap. Okay, the gap, you got a little balance down here. A gap is what? It's a reorder of thinking. It's going back to Kuhn, it's a paradigm shift. We just happen to use it in a much smaller time frame than he would have used it. A gap is also what? It's also excess. I got a little excess there. The gap is excess, which actually confirms this. The market's off and running. I come up there, back down to the destination trade. Does it always happen nicely? No, it doesn't. But at least it gives you some idea of the possibilities, something to think about, and something to judge what is occurring in the marketplace. We said we're going to go back and refer again to the diffusion model. And what you want to think about, here's the excess low on the 5th of February. And this would have been, on the S&Ps. Now review. Who made that low? When you think of diffusion model, who caused the low? Laggard what? Laggard shorts. As the other laggard longs, right? The last longs, laggard longs capitulated, sold into it. The ones that hadn't gone out, hanging on to the very end by their fingernails, those that hadn't shorted, the laggard shorts, and then they were met by whom at the very bottom? The innovators. I don't know if we've got this on the next slide, we'll see in a minute. This was, not only does the excess show here, the excess shows also very, very well on the day time frame profile. Matter of fact, it was a very expensive operation because I was leaving Chicago that day when that happened. I was just checking out of the hotel and it broke and left the excess. And of course, I wasn't going to do it on the plane, but I did see this developing. So the first thing is two sets of laggards. The laggards long, those that hadn't gotten out, finally capitulated down here. Then you get those that hadn't shorted, that finally threw in the towel and shorted, and they were met by the innovator, and it was a meaningful excess. And you can look at that, and you can see how easy it is to identify that excess. Now, remember, this market has come down a long way. I think that was something in the order of 7 or 8% decline, if I remember right. So what have traders and what have investors been seeing the whole way down? Lower prices, lower prices, lower prices, right? The best trade flies in the face of what? The most recent market activity. And while it looks pretty clear right now, boy, it's a tough trade at the time that it's happening. When you start to think about the emotions, how much you second guess yourself, but if you can get your emotions control and you look and say, wait a minute, I understand excess. Then the market started back up, okay? What is this area right here? This would be what? Balance, right? So I have a 1, 2, 3, 4, 5, 6-day balance. The breakout of balance, I have a term, I call it clean or unclean. A clean balance means that the next balance is cleanly above the lower balance. Okay? Is the next balance cleanly above the lower balance? I said at least earlier, you ought to be able to put your finger or pencil mark between them. I can put my car between it. Is the auction young or old? The auction is young. Now we balance again. Even on the balance, what did we get? We got excess, right? So now, then we balance here, a little balance, but we're still, then we get another breakout, young or old. Okay? If you get yourself tied up with price, oh my, this is too high, I'm not buying it here, you're going to have a terrible time and you're going to end up going the wrong way. if you look in here and you say, wait a minute, whether this auction is any good, whether it's lasting for a long period of time, I'm a trader. If I'm a trader, I'm not an economist. If I'm a trader, I'm looking at market-generated information, and the market-generated information is clearly going where? It's clearly going higher. I can see it by drawing a trend line. I can see it by the balances. We have what we call value area trends, where the value keeps going higher. So again, one type of trading in here, right? Another type of trading in here. Go with trades here. Go with trades here. That's the process that goes on. But it started right here with the excess on February 5th. Now the other day when the market broke, it came all the way down to right here. What broke that 1,000, what balanced or brought that thing back in the line was this excess low from February 5th. Those references are important. You have, when things like that take place, you have to be prepared. You have to know what to go look at very quickly. I wish I'd have been more prepared. I wasn't prepared and didn't mentally get it together fast enough. Okay, let's take a look. Following excess, you can begin to think about strategy and tactics rather than coming each day with a blank tablet. Okay, once I have excess, if I have excess and the excess is on the low, I start to think about my trading strategy being what? Buying breaks, selling rallies, right? Buying breaks, selling rallies. Going with the trend. Too many traders trade against the trend. And particularly they say, well, the market's been going down for months. We only got a few days going up. But remember what excess does. Excess marks the end of one auction and the beginning of another auction. When we went down to the February 5th low, it certainly wasn't a scalper excess, right? It certainly wasn't a daytime frame excess. And if it's down 7 or 8%, it's not going to be short-term excess because that's only 3 to 5 days. So at a minimum, what was my excess on the 5th of February? Intermediate term excess at a minimum, right? So the longer the time frame the excess is for, the more significant it is. So my excess on February 6th was very significant down there. And that's why the importance of making that identification, writing that down, will help get you in the right mental frame of mind and open your imagination. Wait a minute, that was intermediate term excess. This could be a pretty significant auction to the upside. That starts to get you back in touch with what's going on in the market. All right, field of vision. When you put it all together, what you really have is the field of vision. This is the name of the video. This is where we've been going for. And as you spend the required time to put all the pieces together, when you get all said and done, you're going to look very much, you're going to play field hockey very much like Julia's friend Megan. You're going to see the field of vision. You're going to be able to shoot straight when you go for the gold. Okay? Talk a little bit about volume. The majority of studies that you will read will tell you that volume doesn't matter. What that really means is that they haven't figured out how to use volume yet. When people do research, what they tend to do, to go to the University of Chicago, I think it's called CRISP, the Center for Research and Security Prices. And they buy these streams of data that go back for many years. These streams of data are only price data. There's no context on the data. They don't know if the price was made on old business or new business. Old business would be short covering, or old business would be long liquidation. New business would be new money coming in the market or new shorts being set in the market. There's no context. They don't know if the price was made on high volume or low volume. They treat all prices as equal. Anybody in any kind of business intuitively knows that all prices are not equal. No two opportunities are the same. So they take this, they can't intuitively resist these scientists that should be smart. And we're talking literally people from the atomic energy research people, out west, Los Alamos, truly scientists come out of there, have been hired by these firms to do this research, and they make the same basic mistake. They start with data that's not reliable, but they can't resist. How can I not work with 40 years of data, right? But there's no context. It's meaningless. So volume, their studies come out and tell you volume doesn't matter. Okay? Volume doesn't matter. Anybody in business, if you raise your price and your volume drops off, you know it matters. Does that mean that it's going to go down or correct immediately? No. But you certainly have to monitor it, and you have to make adjustments. Now, price advertises opportunity, time regulates opportunity, and volume measures the success or failure of the advertised opportunity. But let's put some context around volume. Volume is like anything else. If, for example, let's move forward just a little bit here. Volume in a balance area is not nearly as important. So if I'm in a trading area, I'm in a 4-day or 5-day trading range, the market is fairly well balanced. Volume is relatively insignificant because all the market's doing, it's found a place where two-sided trade can take place. The market's just kind of going back and forth on a balancing area, and volume it's not unimportant, okay? If you have an up day or down day with significantly light or low volume, I will take it into account and I do track it. But where volume is really important is when I break out. If I break out of this 4-day balance to the upside, okay, so I'll have a fairest price to do business for 4 days, just as I have a fairest price to do business for a single day, right? So in order to get away from the fairest price to do business, I'm going to need volume. If I don't have volume, fairest price to do business is going to act very much like a magnet and pull price back to it. So in order to get away from it, I'm going to need volume. And what I want to see, if I break out of an area, I want to see that higher prices begin to bring in more volume. Or if it's going the other way, I want to see that it's bringing in even less volume. So volume in breakouts from balance, far more important than the volume that takes place within a balanced area. Now, that all sounds nice, but let's be honest. We went through a period when the market went up to new highs before it made this historic break a few days ago that took it down 1,000 points, and volume was terrible on the upside. So everybody said, well, Jim, what about this volume? Well, all I can say at the point is volume wasn't high, but the market kept going up. Okay, and why did the market keep going up? The momentum traders were there. Momentum traders are generally non-thinking traders. Whatever it is, they're going to go with it. They're like the people at the pari-mutuel board that we showed before. You know, if you can bet on the race until it's over, you just keep throwing your money at it. Even if the risk return doesn't make sense, you just keep going with the momentum. Then you've got, and I was listening one day to one of the guys on CNBC, and they were talking to him. He's got this picture of him leaning against the door frame, and he said, I really don't like the market in here. We don't like the market, but you know, it's going up, so we're not going to sell. We don't want to sell right now. Nobody wants to sell first. Nobody wants to sell first. So then his comment was, he said, but we're leaning in the door frame so we can be the first out if this thing breaks. Now, do you think he was the only one leaning in the door frame? He wasn't the only one leaning in the door frame. And people said, well, how could the market go down that far? Because they were all leaning, in my opinion, the structure, the volume underneath it was not supportive of what happened. They're all leaning in the door frame, and they're all trying to get out. You know, it's like a fire, get out at the same time. So we were out of line volume-wise for a long period of time. And a lot of people that, you know, listen to what I say and what I write, were having some serious questions about this and say it's not a value. But at the same time, people that read, I'm still a realist. If I got a 3-day balance, what am I going to do, guys? I'm going with a breakout from the 3-day balance, right? I will understand that my structure underneath isn't right. I will have the stops. I will be protective. But I'm not going to sit there and fight the trend just because the volume isn't there. But I do know that the potential for something to go very, very wrong is building in that market. And that's exactly what happened. It's so many of the people here that are our guests today have read some of these things. So they know that this isn't something that was just kind of dreamed up after the fact. Now, and some of my longer term clients took good use of it because they were structured correctly in their longer term portfolios. So volume also, when you're going up on low volume, even though you're going higher, what is happening to the odds of being long? You're still going higher, but your odds are doing what? Are they increasing? The odds of being successful, increasing or decreasing? They're decreasing. They're going against you, right? You're at the tote board and you're down to the point where you're going to get a 201 payoff for $2. The risk reward doesn't make any sense. I'm always taken about the comment that Prince made when he was asked at Citibank, why didn't they get out of some of this toxic stuff? Everybody remember what his answer was? He said, well, everybody was still dancing. Everybody was still dancing. In other words, they claimed they saw the risk, but they didn't get out because everybody was still dancing. So they were leaning against the door frame so they could get out, right? Those things happen. That's where bubbles come from. That's where excesses come from in the market. Let me put it in the same kind of terms that I talked about yesterday. I said I ran an institutional trading desk. Let's talk about the mentality of the longer term traders, and those were a lot of our customers. let's say that you are the head trading manager or senior portfolio manager for a very large fund. They'll all deny this probably, but market's going up, and all of a sudden, you are the first one out of the market. Okay? And let's say you're absolutely right. You're one out, 2, 3, and 4 are right behind you, and you really look great. But so quickly, you get lost within the crowd. You don't get any special credit for being the first one, right? Because everybody's selling. You may have been first, but everybody's selling. You don't get any special credit. Now, let's say you're the first one to sell and nobody else sells. Now, do you get any special recognition? You're the only one that sold. Nobody else did. You're out there on a limb by yourself. And the example I gave yesterday, you probably work for a suit. I was one of those suits. I have my traders out here, my trading desk. And we did business with institutions. You know, but I know how you think. You say, well, why in the world would you sell that? Nobody else was selling. Typical response that you might expect. So why should they take that chance? Because actually, by being right, for the one time they're right, if they're wrong, their job may be at stake. So it is very understandable to me that these markets can go to extremes without people getting out of the market because nobody wants to be first and take that risk. There is actually less risk in the institutional business, the big money business, there's less risk in being with the crowd and having relative performance than there is being against the crowd. Now, we said the guy that made all the money on the mortgage problem with the mortgage area was Paulson. Did he work for a large institution? No. Ran his own hedge fund, right? Who did he report to? He reported to himself. He had the money that he had locked up. He had letters that had the money locked up. Guess what? And when you read the Big Short, how many remember? How early was he on the trade?
It was early.
He was 2 years early on a lot of it, right? 2 years early. Well, now, if you worked in an institution and you're 2 years early, I don't know what institution you're going to be working for by the time what you were playing for actually happened. So understanding those dynamics are very important within the marketplace, because a lot of times people say, well, how in the world could that happen? It's understanding the behavior. But once we got the breakout the other day, what happened to volume? I think they reported one day on the break we had record volume. Well, they were all standing in the door trying to get out. Okay, again, we can't cover it all today and all in one video, but we can at least give you some understanding of the dynamics of what makes up the market. Because we're talking about market understanding, we're talking about logic, and we're talking about self-understanding. So we've got market understanding, market logic, self-understanding. All of these things are important in order to get a holistic view of what trading is about and start to put together the good trades. Okay. And then we're also looking, if we're looking at something, we put a trade on, and once we put the trade on, we do what? Monitor for continuation. So let's say I'm going long the market. Let's say the market starts with short covering. Okay? Old business or new business? It's old business, okay? The chances of old business driving the market higher are reduced, even though we looked at an earlier example with a 10-year bond was at historic rates, or historic short interest, that did drive the market considerably higher. It will happen. But generally speaking, old business isn't going to take it as high as a combination of old business and new business. So if we're monitoring for continuation, we would look and we'd say if it's old business going up, we kind of get the P formation. Doesn't mean it's over. Okay, if we're monitoring for continuation, and the healthiest profiles are going to get elongation because the market's doing a good job of facilitating trade higher and higher. The point of control either does or doesn't migrate in the direction of price. So if we're getting a good breakout to the upside, for example, we're going to have a combination of new business and old business. We're going to get elongation, and we're going to get a point of control that migrates higher. If my breakout, we're monitoring for continuation, it's not very good to the upside, I've got old business versus new business. I don't get elongation, and my point of control doesn't migrate higher. Remember, early on, we showed a place where price was going lower. The point of control did not migrate lower. We had almost a 45-degree angle, and we saw a recovery of a big break late in the afternoon. So you're trying to put these things together in order to understand the dynamics. Okay? Volume and attempted direction. When you look at volume, you have to know what was the market trying to do today. Volume is not relevant if you don't know what the market was trying to do. So if the market opens in the middle, goes up, goes down, goes up, goes down, and you don't have any clear attempted direction, you don't know what the market was trying to do, volume is not relevant. Volume is only relevant on those days when you know what the market was trying to do. So if I know the market was trying to go higher, my question then becomes, what was the market trying to do, and how good a job did it do of what it was attempting to do? So if I open on the low, it's trying to go higher, and if it's really good, I'm going to get increasing volume, I'm going to get elongation, and I'm going to just have a nice healthy market. Opens on the low, trying to go higher, and volume diminishes, it's not a healthy day. So without knowing attempted direction, volume will terribly, terribly mislead you. So in here, volume auctions in both directions doesn't mean much. Over here, opens and auctioned up, we have a pretty clear indication of what it was trying to do. Volume is much more meaningful on this particular day. Okay? Trade location can impact volume. This is a big one. What happens many times, we talked earlier, we came across a major reference up here. When a market comes to a major reference point, you're going up, you're at a major reference point. And we had this example work very, very well yesterday. And I said, from a trading standpoint, if I've got a market going up to a major reference, I am going to exit the trade on this side of the reference. I will put the trade back on if it's accepted on the other side of the reference. So let's say I have a 5-month trading high. So I have a 5-month bracket trading range. I go up there. I'm going to take the long off on this side, That is my high risk area right there. We saw one yesterday, it didn't make it. I think a lot of people thought we were going through. It didn't make it. The longer it took, it didn't make it. As the day went on, we started to break away from it to the downside pretty quickly. That is the high risk area. I have less risk by coming out at a lower price, reestablishing it once it's cleared the top of the range, and reestablishing the trade. That's what professional traders do. That's the high risk area. Now, when you're coming up to that very key reference point, and it's got to usually be a very key reference point, what you may see is volume. You may see volume diminishing. We had another example yesterday where we saw volume diminish up there. It got very fat, we saw it diminish, and then just before the market closed, we saw a breakout to the upside. Well, you say, well, Jim, well, wait a minute, the volume was really low. Well, the nuance was, and we said earlier, nuance is important. The nuance was that it was up near a significant reference. Longer, smarter term traders would rather take it off on this side. They would rather reestablish their long positions on the other side. So you could say, well, wait a minute, we're at the bracket extreme and volume dried up. Not necessarily negative. You've got to relate it to where it was in the trade location and understand it would be very logical. If I come up here trying to take this out, be very logical I come out at this side, even though this one went through. But it was just to give an example. Take it off at a major reference, put it back on if it breaks out on the other side. Okay? When I'm trading, there's a couple different places I can get volume. If I'm trading currencies, the only volume that I'm aware of, Paul, are you still trading currencies?
Yeah.
Okay, where do you get volume from?
CME.
So you're using futures volume.
Futures only.
That's the only volume you have available to you, right? So if you're trading futures in, say, currencies or cash bonds or something like that, or the only place you're going to get the real volume is from the futures volume. My rule is I always go to best source. And the best source in that case may be the futures. If in fact I'm trading stocks, I go to the New York Stock Exchange and I use the composite volume from the New York Stock Exchange because I find that is a better source than is the futures volume. So my basic rule is go where I can get the best source volume. Okay, and then I look at it on a relative basis. Now, and here's what I do on my volume if I'm trading, for example, S&Ps. I take, this is B period, let's say that's the opening. I look in the first period, it traded 650,000 contracts, 935, $1.3 billion. I'm looking, I just track it. I'm not totally up to date, but I just track it throughout the day. I look at what the total is. So I always have some idea of what the volume is doing. I know what it's doing for the period. I know what it's doing throughout the day. I know what it's doing total. But I'm using New York Stock Exchange composite volume, which, if I understand it correctly, is all the stocks traded on the New York Stock Exchange and the volume from as many sources as they can pull it. This is my best source. So again, if I don't have anything else, I'll use futures. But I do not use futures volume when trading the S&Ps. This is a better source and it's more reliable. Okay? Preparing to trade. We heard this before, right? Literally all performance literature recognizes the connection between performance and preparation. Without preparation, we are unlikely to, and you've heard it before, overcome the emotions that really cost us very dearly in the market. Just to recap, I said early, once you have good market understanding, when you talk about traders that really do understand markets, they've got years of experience. Once they got through the place where they understand the markets, they'll tell you that about 80% of their performance is tied to their emotional control or lack thereof. Now, part of the difficulty in learning to trade, people say, well, they want to get their emotions under control first. Well, if you don't understand how the markets work, it's pretty hard to work on the emotions because you really don't know. You need a foundation. You need to understand, you really do understand the markets. Then to start to identify the emotional issues and really deal with them. So, you know, it's hard, in my opinion, to work on both of them together. I think you need that market understanding. And as I told one of the folks that helped set all this up in the first place, what we do on market understanding probably ought to come first, and then the second step ought to be the psychological understanding. One of the individuals in our class today works with traders on the emotional side of the market, but also he trades for himself. He understands the markets. He's getting better and better and teaches the emotion. You want to talk about somebody that's powerful? Try and teach the emotional aspects of it when you don't understand trading, you don't understand what the trader's dealing with. That's pretty tough. I mean, you're doing it in a vacuum. Take somebody like Mark that understands the trading aspects and is going through this in detail and with all the material, and now combine that with the emotional understanding. All of a sudden, you've got a much more powerful weapon out there, and that's really what it takes. It is a combination of both. And the preparation, being prepared, does an awful lot to get those emotions in check. When you're not prepared, you're walking in cold, you can have a lot of problems in the day. Okay? Background. I mentioned this earlier. You need to make, and you're doing your preparation, you need to make a statement. What's driving the market? Okay? Sometimes you have a market that's totally trading on its own. A really strong market with strong conviction trades on its own, and it doesn't care what is going on in any other market. The kind of markets that you get hurt in are the markets that are not trading on their own. They're getting whipsawed by other markets and other influences. Those are markets with low conviction. Those are markets that traders get cut up on very badly sometimes because they have no idea what's going on. I just threw one example up here. This was the S&Ps. It was on a Thursday. Here's the market. There's the high. There is the high on the S&P. There is the low on the dollar. So the market was trading off of the dollar. There is the low on the S&P. There's the high on the dollar. Try and trade that market. Try and trade the S&Ps when you have no idea this is what's going on. That makes it pretty tough. You're going to get whipped very solidly. So you ought to make a note Is the market trading on its own, or is it not trading on its own? Bonds, if you trade bonds, are bonds trading on their own, or are they being driven by flight to safety or flight to quality of what's going on in Greece, in Portugal, in Spain? Okay, those are real things that happen in the marketplace. Whether they make sense or not, when you look at the long-term research, the correlation between stocks and currencies is very questionable when you really look at it academically over a long-term basis. But guess what? In the real world, if this is what the market is doing this week, this month, or the next 2 months, guess what? That's what matters. You're traders. If you're going to be a trader, you have to understand these relationships. And these things happen all the time. So if you start out by putting your back, by just making a small statement as you're preparing to trade and say, hey, this market is weak, it's not trading on its own. Next, I start with a top-down approach. What I'm trying to do is always get as broad a perspective as I can. I start from the top down, then I get all the way down finally so I can develop my strategy and my tactics. If I start here, I look at a monthly, I look at a weekly, then I come over here and I look at a daily. So if I just take the monthly, the weekly, and the daily, do you see the same perspective looking at all of those? Or does each one of those give you a slightly different perspective of what's going on in the marketplace? You know, there's the weekly's come down to here, right? There's the daily going up to here. So you can get, there's the best top reference up there. We just broke above this area right here. Okay, so I've got a breakout on the weekly chart above this level. Which takes precedent, the weekly or the daily? It's going to be the weekly, because the longer the time frame, the more relevant it is. So that's where I start. I start with the background. I then look at the monthly, the weekly, the daily, and I just keep walking through this from a top-down approach. Okay? Let's take a look. In a trending market, where are we in the trend? You've seen some of these charts before. Am I in the early part of the trend? Am I in the late part of the trend? Here I had a multi-day, well, right here, when it got here, I had a 4-day balance, or 3-day balance, right? I looked before it, and I failed. I came back up, okay? So then now I've got a longer balance, but right over here, I would have looked below this. I looked on this day, I probably got some follow through early in the morning, got rejected, I have excess. So I'm looking, not only am I starting very big, but I keep coming down into smaller and smaller time frames. Most of my trading is pretty short term. So I keep coming down to what are my strategy, what's my tactics going to be, and I just start the top down, and then I start looking at and working at it, a step at a time. Okay? What time frame is controlling the market? You know, is it the day time frame? If, let's say, I have 3 days of balance where the market does nothing, it stays very tight for 3 days. Who's probably controlling that market? Probably the day time frame, right? Now I've got, every day I'm getting higher value. Boom, 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 boom. Who do you think's controlling that market? Probably not the day time frame, right? At a minimum, it's the short time frame. If it's more than 3 to 5 days, it's probably at least the intermediate term time frame. The bigger the time frame, the more significant what is occurring in the market is happening. I'll look and I'll see where's the center of the range, just to have some idea where my trade location is. These are all charts you've seen before, but they become part of what I do for my daily preparation to trade. Okay? Now, an inside day. An inside day is a form of what? It's a form of balance, right? I can have balance. I can have 5 months of balance. I can have 3 weeks of balance. If I'm trading 30-minute bars, I can have 3 periods of balance. An inside day is balance. The market has come into balance. Okay? When I come into balance, I find very little incentive to take any trade home from balance. Market in balance, the market is looking for more information before it makes its next directional move. So what I want to do is be prepared to trade any move outside of balance. So I say, okay, if I get an inside day, I've got balance. I start thinking I got 3 scenarios, right? Scenario 1, it stays in balance. Scenario 2, it looks outside of balance, fails, come back in. Scenario 3, it goes. So here, if I have an inside day, if the market opens and starts to trade out of balance to the downside, I want to go with that trade in the morning. Okay? The concepts are the same if you're using 30-minute bars throughout the day. I don't care. I use 30-minute bars, but the concepts, no matter what time frame you're talking about, the concepts are exactly the same. Okay? We talked about this earlier too. A trend we talk about is the market trending. It's not a mutually exclusive statement. You can have a long-term trend up. You can have an intermediate term trend down within the long-term trend up. Be very natural, right? Markets trend up. You get an intermediate term trend to the downside. Within the intermediate term trend, you could have a short-term trend to the upside. And within the short-term trend to the upside, you could have a day time frame trend to the downside. So they're not mutually exclusive. But again, you need to have some idea of what is going on in the market. Right now, it sounds very ambiguous. As time goes on, you will find that this becomes more intuitive and more natural. I was telling the folks the other day, talking about, when you get to be intuitive. For the first time the other day, I took a 2-hour trip on a Segway off of Navy Pier here in Chicago. I've never been on a Segway. It's not, when I look at it, it's not very intuitive, right? To think you're going to stand on 2 wheels and you're not going to fall over and break your forehead or your back. So when you first get on that Segway, you're a little hesitant. You put one foot up, keep the other foot on the ground. You kind of rock that one foot to make sure you're okay. And then the guy that you got somebody coaching you, and he's encouraging you, it'll be okay. He'll hold it and steady it for you, right? You're not sure if you believe him or not. You finally put the other foot up. He leaves go, and guess what? You're standing straight up. You're not falling over forward or backwards. And then he said, okay, now, here's how you go forward. You just kind of lean forward like you're going to fall. I'm not falling for that, right? Oh, no. All of a sudden you lean forward and it starts to go. And he said, when you want to stop, you just lean back. I'm not falling for that either, right? But I decide I want to stop, so I start to lean back. Within about 10 minutes, all of a sudden you realize how intuitive the Segway is. All of a sudden I'm coming down the street and I'm looking, there's a fire hydrant, and it's like skis. All of a sudden You kind of go like this, to the left of the fire hydrant, right around it to the right. You say, wait a minute. And that's kind of what happens to you over a period of time as you're in the market. You find out with the more experience you get, the more intuitive it comes. Okay, identifying trading ranges and extremes. We've been through this again. They're not that hard to do. They kind of fall out. The markets are very what? They're very visual, okay? They're very visual, and you start to be able to see these trading ranges. You start to be able to see excess. Does it happen overnight? No. When you first start looking at it, say, well, you know, do I make it here? Do I make it here? Over a period of time, you start losing the ability to want to make it exactly linear. You start accepting that there's a little give and take in it, and you start to see, okay, I can see some balance. I can look here. I have a balance area here. I break out of this, and I said, okay, if it's a clean break, how much distance should I have between this balance area and the next one? I should be able to put a pencil or my finger, right? When I look at this, it tried to break out of balance here. Is it clean? You see it? It's not clean. It's sitting right on top of it. It's back in it, and we come back down. Does that happen all the time? No. But it is something to record. But I got excess. I start to get more intuitive about excess. I start to get more intuitive about what is a profile going to look like at the end of the day, at a completed day. So you're identifying the ranges, and the extremes. You're just trying to get a perspective of the marketplace. And as you move forward, what makes the market profile unique? We talked about it before, right? The synthesis, it combines everything. We saw the graphic of Napoleon going into Russia. We saw the holistic view of it, the very broad army. We saw the army narrow. We saw the temperatures rise, the temperatures lower. We saw the food supply dwindle. But if you then take it apart, we can study the size of the army, we can study the temperature, we can study the food supply separately, right? So we can take it apart and do more analysis. Successful trading is a combination of both, okay? Again, review. When you go up, we have the first structure we looked at. What kind of business is this? Old business, right? It's short covering. Does short covering weaken or strengthen a market? It weakens a market because it takes buying power on it. We have a primary day. A primary day is a rename. If somebody is reading the original book, Mind Over Markets, we've changed the name on a few of the days because I think they're more meaningful names. There's a primary day. It's kind of our base day that we judge all others from. On the side, we got a liquidating day, a B formation. Old business or new business? It's old business, okay? And you just start, that becomes second nature to you. Let's take a look a little further. We talk about combining things, analysis. So now, let's talk about the combination. I showed you how I track the volume. If I'm trading equities or the S&Ps, I track it by half-hour periods. I look at the total for the day. So now, let's see how I would put this together. Let's say that my attempted direction is up on the S&Ps today, and my volume declines. Okay? I can make an analysis, right? Attempted direction up, I get lower volume. Or I have another day, attempted direction is up, and I get higher volume. So I can take and I'm doing my analysis, I can start to look at volume, I can look at it in relationship to attempted direction, I can look at it to was the value higher or lower, was price higher or lower, you know, did I break out of it? I start to combine these together with my analysis. So it's not a single type of analysis. This is the really good traders do a wonderful job of maintaining holistic view of the marketplace, but also are also very astute in doing the work for analysis. So there's a combination of a little bit of a perfectionist and wanting linearity to it, and versus keeping a holistic understanding. It really takes a balance in there. What time frame is dominating the market? Day time frame references, we've talked about those. Double distribution days, we treat each as two separate days. Again, even on a double distribution day, I've looked to see what direction was the market trying to go. Even if I got it, I'd look at the volume, give me a better idea. We looked at 3-day balance, daytime frame references. We've been through this process. We're just kind of reviewing through it. We've looked at anomalies before, right? Anomalies are rough edges on the profile. They're areas where there was lack symmetry. There's some kind of message in there. We look at another thing in the preparation from the NASDAQ. The NASDAQ has a website, and everybody's got one someplace, but it allows you to go and see what news is scheduled to be announced on this particular day. So on Monday, May 3rd, we can look up here and we can see that we had personal income and outlays at 8:30. We had ISM manufacturing at 10, construction spending at 11. We come over here, we see we have a 30-year bond auction at announcement at 9 a.m. So we know what news is coming. It is important, particularly if you're a short-term trader, it is very important to know at what time a news announcement is coming. Now, I do not want to know what the news announcement is. I want to know when it's coming. I want to read the market's reaction to it on my own. If in fact I read the number, and it looks like a bearish number, and I don't have the basis to know if it's a bearish number or not. I'm reading the headline. The real information is down below the surface. It's below the adjustments. What was the expectation? I want to see how the market reacts in there. And I know there's a lot of crude traders in here. My biggest market has been on the NYMEX and the crude traders over the years. And of course, you know, if you're a crude trader, you can't resist looking at the number, right? Yeah, number, you know, you're addicted to it, even though you know what my answer would be, right? And how many times do you see the market do just the opposite of what the number was? If you got good structure, if you got good solid structure in the market and the number is negative, a lot of times you get a fast dip down, it's gone. Or if there's a strong trend underway, the market doesn't care. Stocks have been going down recently. Good numbers, bad numbers, doesn't make any difference. The market's going lower. All I want to know is what time is the announcement coming. I want to know that because I can expect some volatility around that number, and I may elect not to have a position on at that time. If I'm going to have a position on, I want to at least understand what is going on in the marketplace. The narrative is nothing more than putting into words what you're seeing in the marketplace. It's the recap of all the work you've done. After you go through, you look at your references, you look at your background and everything else, you want to recap it into a narrative form, written form. You don't want it to be very big because you don't want to create a bottleneck. If you make it big and you write a book, all of a sudden it's like running. You run a half a mile today and a mile tomorrow. Within 3 days you're no longer running because it's too long. You don't want to create a bottleneck. But what nobody disagrees with me usually initially about this, but the number of people that actually will do the narrative that we recommend is almost minuscule. Sounds good, but everybody knows that they understand it, they know what's going on. They don't need to do that. All of a sudden, you know what's going on. When you go to write a narrative, all of a sudden, you start to write the narrative and the words don't flow very easily. What do you think your grasp is of what's really going on? It's not very good, right? If you're writing the narrative, you really understand what's going on, it ought to come off real quick and real smooth. The process of writing the narrative, say, okay, the narrative may say nothing more. I'm in a 10-day balance. My trade location is at the top of the 10-day balance. Structure has not been very good on the upside. Volume has been declining. I'm looking for, I don't know what it's going to be. We'll send you something to kind of help you with that. It doesn't have to be a book. But that, if you do that, you got a much greater shot of doing the right thing when the market's open in the morning. Some people mistake a narrative. They spend a lot of work and they put in the reference points. They mark the reference points and they got stars here and notations here. That's linear work of marking the references. Easy to work, and it's good work. Boy, you really feel busy. You get straight edge out, you can draw trend lines, you can do this. Boy, I really worked hard. But you haven't gone to the other step of writing the narrative. If the background, maybe the narrative says nothing more, that the S&Ps are not trading on. They're not trading on their own. They're still being influenced by the movement in the dollar, affected by what's going on in Europe and with the euro. Okay? You already knew that, but writing it down puts it in a different location in your mind and brings it front and center to what you're doing. Also in the narrative, the very last portion of the narrative is you ought to develop 2 or 3 trading scenarios for tomorrow. So you ought to have 2 or 3 things that you know you want to do if you get the right opportunity tomorrow. It's a lot easier to react when you already have thought about it. There's enough things that come up in the market that we never thought about, didn't imagine, that come out of nowhere. If we can get rid of and be prepared for those that are expected, it's easier to handle the unexpected. But we will give you part of this when we get it done. Will be a write-up on it. It's really a way to put it to put it all together. Let's take a look now at what you might look at a real week in the market. The example provides us with an extreme unique opportunity to appreciate structure, how structure forms, how structure relates to object-based trading, and the intention of this market situation is to bring into focus those things that we have talked about today. So it's the week of April 19th, or April 9th to the April 16th. Let's back up one slide for a second. So there's the week we are focusing on in there. There's the 9th, there's the 16th. Okay, let's go forward. Late Friday. Remember us talking about this day earlier? We showed this day earlier. Late Friday, when sellers didn't appear, momentum traders pushed the prices back up. No elongation. Longer term frame sellers have limited interest in here. Limited interest here we never would have gotten here. The low was made early. It was a poor low. Tempted direction was up. So that's my starting point. That happened on a Friday. We introduced this early. Now you're seeing it again. We're going to walk through what goes on. Now, when I look at the second day, well, first of all, when I do my scenarios, I got a pretty good idea. I saw this day, this Friday. I knew there were no sellers, but I really didn't think this was real, and I didn't think it could hold this. It didn't have the volume. I didn't have the shape. I didn't have the conviction. I had a pretty good feeling that I had momentum players playing a game on Friday afternoon. Why? Because they can, right? And price-based traders, market's up, they buy it on Friday afternoon. It's like going to the track where you can change your bet. Why not? It's going up. So they come along, and on this is a late spike. Let's talk about spikes for a second. This is another example of a spike late in the day or a price probe to the upside. Okay? If this is the late price probe up, this is the base of the spike, what is this called? Support, right? The base of the spike is support. If the market opens and stays within the spike, is the spike accepted or rejected? It's going to be accepted. Over time, we're getting accepted. If it opened above the spike, and if opened above the spike, the market hadn't gone high enough to cut off the buying. So when I look at this, part of my scenario, I think there's a pretty good chance we're coming back here. But I don't know that. You never know anything for certain. Then I get a balanced, pretty balanced day on Monday. I'm within the spike, but it never got down here. It never got down through support. Okay? So value is higher. However, no elongation. I have a wide point of control here. I have down here. No real evidence of longer term buyers because they really didn't push it. Sellers remain absent. Poor low, poor low. Now I have a poor low here, right? And I have a poor low here. Let me give you another difficult concept. I don't use a point count, but let's assume that I did. Let's say if I had a poor low, I called it a -5. So let's say I'm doing some computer model. Poor low I call -5. Okay? I don't do that, but let's assume I did. Now, if I had one poor low, that's a single data point. It may or not be taken out. It's significant, but it's minor. If I have two poor lows back to back, I now start to get some exponential type of evidence. So if one poor low was -5, maybe two poor lows back to back might be something like -25, -30, -35. So I kind of get an exponential expansion of two poor lows back to back are really increasing the odds. They're increasing the odds against that person that's long. They're increasing the odds that I'm going to have to look below those lows. So I go through that. I got two poor lows back to back. I've got my support. I haven't gone through support here. Okay? So I didn't get through support. That's positive, right? I got accepted, positive, but I got two back-to-back lows. Am I getting conflicting information? I'm getting conflicting information all the time. If, in fact, there was no conflicting information, the trend would be going in one direction. Everybody would be very much aware of it, right? What is my opportunity? Pretty limited, right? Be very limited. Within the conflicting information starts to make the situation more ambiguous, right? More ambiguous it is, the more opportunity I may have if I can wade through that and find the opportunity within that ambiguity. Remember, most people loathe ambiguity. They want to know, where do I get in? Where do I get out? Jim, this is of no value to me. You didn't tell me where to buy. You didn't tell me where to sell. I don't need you. And I said, you know, that's not what we do. It's not really how markets work. And if it was that simple, it would be arbitraged away in moments. It would be in some computer program, on some algorithm overnight. Okay? The power in this is understanding the complexity and the ambiguity. So now I've got conflicting information. It was also interesting. One of my friends at a hedge fund told me, he said he was talking to other people at the hedge funds, and they had sworn off shorting. They had sworn off shorting because every time they shorted, they got punished. They weren't going to short anymore. So I just wrote, I said, can the correction be far at hand? And it's amazing, even hedge funds are supposed to be sophisticated. One of my jobs, when I went back to UBS in 2001, they had a problem in the hedge fund area. They were getting some suits, and I was asked to come back, review the process, and review a lot of the hedge funds that were in the system or should be in the systems, etc. So I went back. It was an interesting job. No hard feelings. My wife had passed away. They asked me to come back. It was an interesting situation, very challenging, and it was fun. I learned more by talking to all these quote unquote sophisticated hedge funds and traveling the country, talking to them, interviewing them. And it was also fun because I'd go in and they think, here's some guy from this brokerage firm, so they're just gonna, kind of blow a little smoke at you, close your eyelids, and you'd sit there and listen to them. And when they'd get done talking, you'd start to ask questions, and all of a sudden they'd say, uh-oh. They'd start to get a little upset with some of the questions you ask, and all of a sudden they realize, wait a minute, maybe he does know something about trading. Well, then you get in there and you start to say, wait a minute, what do they know about trading? And I can remember coming back from one trip and saying, every single hedge fund I talked to on a swing through the West Coast, and I saw 10 of them, and they were all pretty good size, every single one of them had the same basic position. Somebody came up to me earlier and they said it was amazing that I mentioned Bear Stearns, because they said they used to be on the floor of the exchange, and they said it was interesting, if Morgan Stanley and Goldman Sachs did a trade, Bear Stearns would imitate the trade immediately. Well, guess what? When you get everybody, longest time frame, going the same way, what is your risk? And when they try and get out the door, what do you think's gonna happen? Okay, so when we go back and look at this, we've got two bad lows back to back on there, and we start to look at what's going on. Now, we come in on April 13th, we talked about this bad structure down here, the two bad lows. Now the market, we open lower, we go back. We don't take out this low, but we repair this, we take out this low, and the market has come back down. And check this out. Remember, I thought this was kind of bogus the way it broke out above there. I think it's pretty hard to hold this when it's this fat. It got up here probably on a Friday afternoon, couple bad lows. It did come back, and check it out. The market, one of the things that's interesting here, the market is very much like we are as people. You know, I would really, as I'm sitting here doing this video, and I know some of you I've never met before, some of you do know, and the temptation is you want to say, hey, how am I doing? Am I doing okay? Because it's all a little bit of our insecurity coming out, right? And the market is very similar. If you think about it, it's a composite. But this, in a way, I always have looked at this, is like the market coming to check this out and saying, how am I doing? Am I doing okay? And it comes down here, it revisits this area, kind of repairs this structure, and it gets an affirmation that everything's okay, right? And then, once it's checked this out, it gets encouragement, everything's okay, and the market starts back up. We get our buying tail, and we start to go back and auction higher. So the early break Tuesday repaired most of what was going on. Now, when we said we went down and then we went back up, one of the things we also were getting, what kind of information were we getting? Conflicting information, right? So guess what? Both that we got that took that conflicting information, we went lower and we went higher. The question is which one was going to happen first. But as long as you know that and you can go through that process, you can get prepared. If you had this as a reference point, you get down there, you didn't take out Friday's low. Do you have a reference? Should you have had that already on your chart? Yes, you should have. You get down there, you don't take it. Now, when you didn't take it, did it come out of here quickly or slowly? Came out pretty quickly, right? So as it got down to the low on Friday, traders were ready to do what? Remember, on the floor, this means buy, right? The longer the tail, the more aggressive they were. And they didn't even let it get to the low. So there was some aggressive buying going on. You've got excess. You saw excess a while ago, longer term excess from the February 5th low. You're seeing a little different type of excess right here. So there was conflicting information, but the pieces come together, and if you have a mental flexibility, you can make the analysis and you can work through trading these markets. References are extremely important. Volume, shape, repair. Okay? Here is a perfect S&P trade if you are prepared for the trade. The market gaps higher. The market gaps higher, and it gapped higher in A period, trades a little higher, and in the second period, B period, A period, B period, comes down, and guess what it can't do? It can't close the gap. That is your perfect day time frame trade down there. Now, when you get down here, it's kind of strange because remember, it went up which way first? Went up in A, then it came down in B. There's a word I use, it's called, how many people have heard it before? It's called tempo, right? Let me tell you what this looks like if you're coming down towards that low. The tempo, the market will have trouble taking out this low. The tempo will start to slow, and it will kind of push like this, and it'll kind of push again. And one of the things that you learn with cumulative experience is to feel the market. If the tempo is slow, you're above yesterday's high. You have the longer term traders that wanted to sell can sell at a higher price than they could have yesterday without a question, right? The market's coming down and the tempo is slow. Do you think the longer term sellers are there or the aggressive sellers are there? No. Now, I'll get all kind of questions. Well, Jim, explain to me again what tempo is. You have to experience. But if you know to look for tempo, over a period of time, you will start to understand what tempo is. You're in the traffic. You know, if most of the traffic's going 67 miles an hour and you're at about 66, 67, your tempo, your flow is pretty much with the traffic, right? Now all of a sudden you're in and out of traffic, you're trying to get someplace, your tempo's out of sync with the traffic. That's another form of tempo, right? So when you're coming down like this, the tempo starts to slow, and all of a sudden it goes through your mind, you recognize it. You don't have anything other than tempo to go on. You have your reference, you're watching the gap, you're trying to see if they can close the gap. They can't close the gap, that's your buying opportunity. However, if you got your mind all messed up, oh, price opened higher, went higher, now it's trying to sell off, oh my golly, this thing could really destroy me. Now you brought yourself to a point of indecision, you can't make the decision to get long that market. Going long this market at the right price is going to fly in the face of what's been happening for the last half hour or so, right? If you have nothing, you have no context, you don't know it's higher, you don't know you got the gap, you don't know the tempo's slow, you have no context at which to judge what's going on. Or another situation, you're going to trade the S&Ps, the market's going to open substantially higher. You see the overnight trade is substantially higher. It would be expected when the market opens, the first thing you would expect traders to do would be what? Take some profit? So the market goes substantially higher overnight. The first thing they do is they're taking profit. And if you don't understand, it's just a little profit taking. You get sucked into profit taking, and all of a sudden, you're not going to get lower value. You can't close the gap. All you got was some profit taking. You remove some weak longs from overnight, chance to get long the market. But if all of a sudden you're focused on that price, you saw price, and a lot of times when the overnight inventory is long, you open higher in the S&Ps, you may see them starting to sell from the open bell. Oh boy, this market's really weak. Then all of a sudden you realize, wait a minute, tempo's slowing, they can't get the gap. And you'll see this situation, and usually can be a pretty good trade. The good for a daytime frame trade now, as the market starts back up, now you start to look to see how smooth is that auction to the upside. It's a two-way auction process. Continually auction from low to high, high to low. Each auction contains within it evidence that's going to help you determine what the next results of the next auction or the following day may be. Years ago, before they changed the tax law, and I was working for Payne Weber, and in the institutional area, doctors and dentists and corporate people that wanted to have an outing and they wanted to write it off for tax purposes would have it at a nice location, and they might come along and invite a speaker. So they had a speaker, they could all get together after skiing and something, and have a few beers and have a speaker. They all write it off, right? They changed the tax law, made it a little more difficult. Well, anyhow, this one was in Las Vegas. Now these guys, they probably got there the day before. So they're probably fairly tired. They've been out golfing and meetings and drinking all day. And now they've got to come and attend this seminar where I'm going to be the speaker that night. I'm going to talk about an inviting opportunity. So what I decided to do, it was on trading, but I decided to give the whole seminar that night, which I was going to keep to less than an hour, on blackjack in the market. And it's probably one of the best receptions I've ever had, because normally what these guys they come in, sign in, sit down, they've physically been there, if they ever get questioned, and they're gone. No one left. And they said, we're going to talk tonight about trading in blackjack and the similarities. And one of my first clients ever when I was in the brokerage business was a guy named Ed Thorpe. Ed Thorpe was his original book was How to Beat the Dealer, had another book, How to Beat the Market. One of these guys was a card counter, professor, University of California, Irvine campus. They finally told him that he might not want to come back to Las Vegas in there. So I had a pretty good idea about the blackjack and the cards and what went on. But the main theme was in blackjack, because Ed was a card counter. I visioned myself as a card counter. I don't remember ever needing a guard to take me home from Las Vegas. But I said, in card counting and in blackjack, what has been played before has an effect on the statistical outcome of the following hand, right? And assuming at this point, I'm so old, they played with single decks. They didn't have shoes and all of those back then. But what has been played before affects the outcome of what's going to happen forward. And I said, in trading and in investing, what has played out before has a lot to say about the odds and the outcome going forward. we saw the example earlier with 2 poor lows. Okay? I think that has a lot to say about the outcome going forward. And that is kind of what this idea of cumulative evidence about the market. When the market was going up before it made its historic break, a week or so ago, the structure, the cumulative evidence was saying that there was a tremendous amount of weakness in the market. Did I know it was going to happen? Did I predict it? No, but I knew that the evidence, that the underlying structure was relatively weak. Okay, let's take a look at what we've got here. Overnight trade. Very briefly talk about what I do with the overnight trade. I already told you I use the overnight trade only for the reference of the high and the low. I also use it for one other thing. Was the overnight inventory long or short? It's an awful difficult concept. If the overnight inventory, if the close yesterday was at 6, and all the overnight inventory takes place above 6, I come in and I say the overnight inventory is long. Now, the trouble most people have with making any sense out of that is, in a simple form, the economists will tell you, well, Jim, who cares? There has to be a buyer for every seller, right? Well, it's a buyer for every seller. What do you care what the overnight inventory is? The key is there doesn't necessarily have to be a long-term buyer matched with a long-term seller. What if I have a long-term buyer matched against a short-term seller, or vice versa, or any combination thereof? If General Motors is a long time frame manufacturer, right? In the business, they'd be considered long time frame. Okay? They are then selling cars, or putting cars in the hands of the dealer. Do the dealers have the same motivation as General Motors? No. What does the dealer wants to do? He's a short-term player. He wants to put a markup on it, right? He wants to put a markup on it, get it out the door. Put a markup on it, get it out the door. The dealer is very much like the local used to be on a trading floor. So we've got an imbalance between what the long time frame seller wants to do and what the short time frame buyer wants to do. In Markets in Profile, the last book I wrote, talked about this example from the housing market. When the market first started, you had a contractor that built a home, had a contract. He built a home for a buyer. That buyer was going to live in that home, right? You've got a pretty good match between the buyer and seller. Well, as the market got a little bit hotter, the contractor decided he'd build one on contract, but maybe he'll do 3 or 4 specs to go along with it, right? All of a sudden you've got the buyer, instead of buying a home that they're going to live in, well, maybe they'll buy a second home. So we found near the top of the market, but I don't remember the exact number, it was like 38% of the people had a second home. Then you had other people that started to talk about flipping the homes, right? And we went to this woman down in Naples that had 50 homes. Well, you kind of get an idea of the imbalance that can exist between different time frames and different motivations. When you look, let's say that the overnight inventory in a market is higher. The overnight inventory may represent only 10 to 15% of the same type of buying that would take place during the day. So if the market's up overnight, I know the high and the low, and if it's up overnight, I'm going to make assumption that more than likely I've got the inventory in relatively weak hands overnight. Doesn't have to happen, but I kind of start and I want to know that. So I will take a look at that. I will also use the overnight market in order to place trades. I don't very often trade the overnight market, but that doesn't mean that I won't put an order to buy something at some level that I want to buy it if the trade's down there in the overnight market. Earlier, we talked about a pullback low or some anomaly in the marketplace. Here was kind of an anomaly in the marketplace. Thought it might come back to. I had an order in to buy at this level overnight. And it got down to that level. Do I necessarily recommend it? No. But I had a reason for wanting to be in this market. And I said, okay, where might I put an order? This corresponds to about half back. It corresponds to this anomaly. And you can see the market went just a couple of ticks below that. So from time to time, I will use that in order to get the markets that I want. I also will say, if in fact the market can pull back too high overnight, too much overnight, if the market was really strong, it probably couldn't pull back that much. So again, I will gain information from that. Remember, it's nuances. It's nuances, okay? Let's just kind of see where we are. Let's move forward on here. Thursday in here, build higher value. Remember, we did the buy overnight, higher with the trend. Markets really having trouble going higher, kind of going higher on vapors. The low was early. We came down and took it out. Did the point of control migrate higher? It wasn't able to migrate higher. It's a sign that there really isn't a lot of strength in the market. Now, remember, we looked at this base. Finally, we got down below this base. First time we got rejected, but it's not a healthy structure. Higher value, it's moving higher with the trend, failure to elongate. Why didn't it elongate? Okay, because more than likely it's going higher value, but what's stopping it from elongating? What is stopping the point of control from migrating higher? More than likely, it's a longer time frame, being very patient, saying, you bought some, you bought some more. Remember my example, the guy from one of the grain companies in Minneapolis, come on the grain floor, you bought some. It's a nuance. And those nuances are very, very important in the market. The market, you start to get a feeling that the market is very, very heavy. You get a feeling it's running on vapors. You get a feeling that the risk is getting to be excessive. That is a very poor low, right? We saw a low. We could have a low with 5 ticks. We could have a low with 1 tick. Now the second tick off of the low is 3 wide. I wouldn't want to go home. I wouldn't want to go home long this market for anything. If something goes wrong, some exogenous event, it's not going to be able to support it very well. The market's getting very heavy. Let's take a look what's coming up. The market down there is heavy, but we saw this slide before, right? Even though it looked heavy, was it trading on its own? It wasn't trading on its own. Guess what? When a market's not trading on its own, I don't want to be involved in the market. The risk is too great. There's just too much uncertainty. Okay? Friday, April 16th, poor high indicates that a market has gotten too long. Remember, early on, I made the point, we started off and we talked very simply about buying tails and selling tails, right? And I said at that point, careful, it's more complex than that. I also know that when people first hear about buying tails and selling tails, they want to run out and they want to look for opportunities where they can buy with a buying tail and they can sell with a selling tail. They haven't understood the complexity of it. And I did make you a promise. I made you a promise that as we got through this, it would be more complex and you would start to understand the difficulty. You would start to understand why somebody in one of the chat rooms said, "Oh, this is just it's just too ambiguous. It's just too intense. It's not for me." And that's right. It's not for a lot of people. When you get the complexity up here, a poor high, in one sense, we'd say a poor high is indication that the market is not what? It's not completed, right? So in one sense, we say, oh, we're going higher. The market's not completed. But in another sense, and you have to take this in context, if this happens early in a rally, or if it happens very late in a rally or a trend, now as it happens later and later, if a market gets too long, those that are too long get very, very nervous, just like those that are too short get very nervous. So if they get too long and all of a sudden start to get a sense that they're caught, they're going to be selling every high. So you get up here, poor highs can also indicate a market has gotten too long. Very confusing, right? You say, well, wait a minute. In one sense, it says the market's not completed. It may be, you may have a situation where the market is not completed for one time frame, but it is completed for another time frame. So this may tell us that a next longer time frame, we're not completed. But for the shorter time, the market is too long. Then you combine that, the poor high, you combine that with the point of control not moving higher, and you start to get more and more evidence that you've got a market that is too long. Now, traders will continue to do what works until it doesn't work anymore. Buying breaks, they aren't getting much for it. Start thinking the diffusion model, okay? When you look at a break like this, up there, all of a sudden, you got some people selling into the rally. More than likely, who are they? They're the innovators, right? They're the innovators. Now, the market starts to come down. Another concept I want you to think about. This gets me thinking, because you say, well, it didn't pull back very far. But you've got a whole lot of longs in there. Think drip, 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 drip. The longer, if you're holding long positions, the longer the market drips on you, the longer you don't get the satisfaction of rallying the more uncomfortable you get with your long position, the more anxious you become to sell it. So now you're selling on the high, you're selling on high here, even though, remember, you may have a situation where the innovators are doing what? Selling. Some early longs are selling, but the momentum traders are still doing, buying every what? Buying every break, right? So see the dynamics in here. Not a lot of the momentum traders, non-thinking, they'll do what works till it doesn't work anymore. So they're buying every break. They're getting less and less for it. The innovators, or those that are longer term, a little long, they're going, you bought some, you bought some more. The example that I like to use, and I don't know if this will show up from the video, but I saw somebody do this example years ago. If you take a coin and you spin that coin, you get less and less and less and less and less each time. So if you think about that, the buyers are buying every break. They're getting less and less each time, and finally the last time they get nothing, right? So they buy and then they have to turn around and sell immediately. It's a process. Highs and lows are made via a process. So now they were selling up here. We got another day that we're selling at the highs again. Value here is going to be what? Value is going to be lower. Price and value are going to be lower. Remember early on we said this was the top of a spike earlier. We got into the spike a little bit the previous day. We're back down into the spike, below the spike. We broke support. Okay, it's kind of a process that goes on. Okay, so let's move forward and see what we're looking at. So the second half of, you see the second half of Friday take place, and you get more of a liquidating break. You can see the culmination of that process, right? You see the process, you saw it in profile, you saw the process, you saw the cumulative evidence, you were getting less and less each time as the momentum players were coming in. We saw evidence that we saw selling by the innovators. We saw the momentum players still buying every break, and finally it all comes apart. A nuance, usually on a big meaningful break, about, if you've done your references right, it usually takes about 3 good solid references to contain a meaningful break in the marketplace. So what we've tried to do, we've tried to walk through some examples that are relatively current, tried to give you a feeling of a relatively complicated process, tried to give you a feeling of where you saw, clearly you were seeing conflicting information in here, but yet you saw the final outcome on a break moving pretty sharply. Odds-based trading, you're continually trying to assess the odds. The poor underlying structure coming into Friday had increased the odds against the longs, right? It didn't predict the break. Okay, it didn't predict the break, the poor structure and what was going on, but it certainly increased the odds that the conditions were right for something like that to happen. We very often will see that a daytime frame auction struggling to trade higher, there's information in that. Structure weakens, volume declines, however, price doesn't decline. but the odds have changed. The odds have changed. So sometimes, even if price doesn't indicate the change, the weakening structure, the lower volume, and all those things will indicate that the odds are changing. We as human beings are not well programmed to think in terms of odds. It's just not, from all the research I've read, we are just not naturally programmed to be odds-based thinkers. We take exceptional risks that we never think. I mean, we drive cars on ice, and I live out where everybody's got a four-wheel drive vehicle, and they know that a four-wheel drive vehicle, you can drive any place on snow and ice, right? And of course, you go by and see them up down, but we're upside down in the road all the time. We're just not good at odds-based trading. And what I'm trying to get you to think about is, as you transition, think about being an odds-based trader, think about cumulative evidence, and how do we get to make intelligent trades? How do we control our risk? Remember, we can control risk. We can't control return. What I would suggest that you do from here is take this information. We provided you with a workbook. In a few places in the workbook, I incorporated some things that I thought were relatively important, left space for you to take your own notes, and hopefully we added additional information today. It will not come easy, I promise you. I will think that the odds are very good. If you stick with it, you will benefit tremendously from this. And as Julia said early on, you will probably never look at the market twice the same way you used to. You look at it entirely different than you ever thought about looking at it. You probably never thought about excess and balance in the same framework. Hopefully what we've done is given you a base from which to begin a whole new way to look, understand markets, and to advance your trading career. And most of the people we deal with are already professional traders, or their goal is to become serious professional traders. I'd like to thank a few people. Window Trader, owned by Terry Lieberman, provided a lot of the charts. Window Trader and CQG. CQG is the quote vendor I use along with Window Trader. Also were very instrumental in providing us with a lot of the charts and the graphs that we use today. I really want to thank you very, very much for coming out, spending this time, and have a great trading going forward. Thanks.